This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Why are we upset if we're creating jobs?
Inflation is still a thing out there for the everyday consumer.
With Lisa Mateo on markets.
The economic calendar jam-packed today.
And Michael Barr with news.
Tensions between the U.S. and China have heated up even more.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Lisa Mateo. No one's in today. We get Damian Sassower. We dragged off the golf course. Thrilled that Damian Sassower is with us. Perfect timing. We're going to go to Japan and the markets, the international effect of this equity pullback and some of the gyrations with lower yields as well. I can't say enough about the news flow right now. I actually, Damian, I yelled at one of our interns this morning.
You did?
Yeah, I'm in the Mike Bloomberg timeout chair.
I'll tell you, your rate is doing nothing for my golf game. My index is going to suffer this summer.
It is. It's going to suffer because the news flow, folks, is absolutely extraordinary. Top it off, we're going to talk to Ed Ludlow in a moment. Chevron, get out of Dodge. They're moving from California to Texas. We've got Intel blowing up, Anurag Rana to give us wisdom as well. And moments ago, James Dimon publishes in the Washington Post. Does he think he's upset? I call him Secretary Dimon.
Secretary Dimon.
I think I'm trying to get out front of the story. We're going to get to the data check here quickly because the news flow, again, on this jobs day, extraordinary. From the Interactive Broker Studios, our Bloomberg Business Flash, John Tucker.
All right, Tom and Damian, after yesterday's 2.3% sell-off in the tech-heavy NASDAQ futures this morning down another 1.7%. The weaker economic data pushing the benchmark 10-year Treasury yields down below 4%. Thursday's trading, the S&P 500 underwent its largest intraday swing since November of 2022. That ended down 1.4%. Economists think this morning's jobs report, that's 8:30 Wall Street time, will show an ongoing softening in the labor market. And according to media estimates in a Bloomberg survey, payrolls probably rose by 175,000. Apple shares, right now they're higher in the pre-market, delivering a strong performance, but they also had slower sales in China. Intel pre-market, Intel plunging down 20%, downgraded after that weak sales forecast. And investors also focusing on Amazon's softer view ahead for profits instead of the strong results for its cloud unit. Right now, we have Dow futures 343 points lower. That is down 0.9%. S&P E-mini futures 59 points lower. The NASDAQ futures down 309. Two-year yield down 2 basis points. The 10-year 4 basis points lower, 393. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Damian and Tom.
John Tucker, thanks so much. We're going to start strong here. I'm going to talk to Damian Sassower about this equity pullback and the linkage into global slowdown, something many have looked for. I'm still getting over Wei Li of BlackRock yesterday, talking great about a 3% GDP handle on China as well. We'll then go to Anurag Rana on Intel and tech. We'll finish up, on tech. And then we're going to try to crowbar in here Edward Ludlow on his way to JFK. We're going to talk to Ed Ludlow about his really encyclopedic knowledge of Intel. Let's go. Damian, Japan. They finally blink. They changed their monetary policy.
That's right.
I get yen appreciation and their equity market tanks. Is it linked to the tech pullback in America?
Absolutely. It's all linked to Japan. I mean, Japan has been the funding currency du jour, not just in fixed income, but in equities as well. So let's talk about leverage buying. Leverage buying is coming off here because, quite frankly, the yen is melting down, and it's all about Japanese real rates. I mean, we could talk about real rates here in the U.S., Tom, 176 on the 10-year, but in Japan, they're super low, and it really has something to do with the fact that basically wage growth is actually showing up in Japan, go figure, and now the markets are rushing to price in another hike in October. The BOJ is notorious for disappointing markets. We got to wait and see.
They're hiking. Bank of England is cutting. When you talk about leverage, Good morning, Global Wall Street. Thrilled to give you Damian Sassower. Damian, when you talk about leverage, I'm sorry, it's August. Mm-hmm. Does this harken back to the leverages, plural, of 1998?
I mean, this is the illiquid summer months, right? I mean, everyone's on vacation. Everyone's in St. Tropez. I mean, for those of us who can afford it. And look, the fact of the matter is seasonals matter. Right. And so on illiquid sort of conditions, I guess what you're seeing here, any shift in sentiment, and this is, quite frankly, Tom, a very big shift in sentiment. It's the first time in 6 since U.S. real rates are in positive territory back in May of 2012. first time in 6 that it's not been a rate tantrum that's causing a sell-off in the market.
That's the uniqueness of the market right now. SPX down 1%, NASDAQ continues down 1.5%, and the VIX over 20.
Over 20.
20.34 this morning. From Chicago, Anurag Rana joins us, Bloomberg Intelligence. Anurag, thank you so much for joining us. Is this a tech pullback, or is that just one part of the equation you see in the market?
Yeah, I mean, it is a minor tech pullback, but that's sometimes a healthy thing, because if you look at it over the last 1.5, 2 years, we have seen a massive rally in all these technology stocks because of AI. And right now we are at a phase of consolidation where the companies are spending a lot of money to expand capacity with the hope that they get more AI workloads down the road. So I think that's where we are right now. We're going to see this for a few quarters. And we think it's going to be a good 2025.
I went to the Anurag Rana FA screen today on Apple, and I noticed that Apple in the last 10 years has retired 37% of their diluted shares. I think historically, I can say, Anurag, it's never happened before. Are we going to see this trend of massive free cash flow from these companies where all the noise of AI and all really doesn't matter?
Yeah, when you see all the tech companies, I think Apple really stands out because their AI policy or strategy is different than the other tech firms. Last night, they actually bought back about 26 billion in shares that quarter. This is the highest we have seen. And this is a company that's not going to be spending billions in terms of expanding their data centers because they're rented from others. They're going to rent a large language model from everybody else. So their dent to free cash flow is not going to be as much as it's going to be for Microsoft and Amazon.
Anurag, only a 5.5% pullback in the S&P IT index over the last week. So you're right, not so strong. But talk to me about what we're seeing here. I mean, is this the beginning of? Should we be doubling down on growth, or should we be shifting into quality here? I mean, what are your thoughts?
So, Damian, when you look at it, there are two things that are at play right now. Right now, we are at a phase when these companies are spending so much money and they can't show a lot of the AI revenue. So investors are questioning whether that's going to happen. The second thing that you just mentioned is the rotation into value and rotation into small caps. And I think that's another play that's going to happen over the next several quarters, because the disparity between the large cap in the tech world and the small companies in the tech world is massive at this point.
I got to leave it there, Anurag. I'm so sorry to short you this morning. The news flow just exceptional. He is definitive on the cloud. Look for Anurag Rana at Bloomberg Intelligence writing up cloud forward. Joining us now, we're thrilled. His bags are packed. He's ready to go. Back to SFO. Ed Ludlow joins us here with crazy news in technology. Ed, you and I got an hour conversation. We're squeezing into 4 minutes. And the answer here is you're encyclopedic on Intel. It's not my father's Intel, is it?
No, it's kind of flailing like an industrial company that lost its way in a bad economy, and that's not what's happening, right? What happened last night is the CFO phoned me, David Zinsner, and the admission was, yeah, the results aren't great, but the bigger admission is that they're not doing the right things at the right time. The markets that they're traditionally strong in, PC and legacy data center, are not going very well for them, and they've just overinvested. So they had this turnaround plan that they've spent too much money on while revenue's fallen away, and
I'm going to talk to you about the culture in San Francisco.
Yeah.
Frankly, Silicon Valley. They're going to lay off how many people? 19,000?
It's about 15 to 16,000.
But the answer is the top 10% of the employees they have that they don't want to lay off, they're going to lose them anyways, because the best people at Intel are going to say, why do I need to put up with this? They're going to go work at 14 other companies.
There is a war for talent in the semiconductor space for those working on the lucrative market, which is AI accelerators. They actually didn't say where those layoffs would be. One big point of difference, NVIDIA has 29,000 employees. Until the cuts come into force, Intel has 110,000, right? Why does it have 3 times as many? Intel has a fab or foundry business that the other chip makers just don't have to worry about.
Ed, I'd just like to ask you, you said a war for talent in chips. And, I'm thinking SK Hynix, I'm thinking Samsung, I'm thinking Taiwan Semiconductor. Those companies don't pay their employees in dollars. So when you're an engineer, you're working at Intel, you're working at NVIDIA, are you even thinking about that? I mean, are they even thinking about, the benefit of getting paid in dollars or in another currency?
It's a really smart question. By the way, the war for talent is a quote from AMD CEO Lisa Su when I spoke to her 2 days ago, not mine. But I'll throw this back at you. One problem NVIDIA has, it actually has a problem that no one talks about. All of the brilliant people there have been there 10 years. What does that mean? stock comp. They're all
yeah.
millionaires, but they're ready to go.
Yeah.
So now you've got to balance the books as the CFO, right? You know, when you look at comp as the financial controller, you're like, that's difficult.
And these guys are now able to sell their shares.
We don't have these conversations at Chipotle on 56th Street.
No, we have them at Tamarack Country Club up in Greenwich,
Damian.
Connecticut.
Do you know how it feels to write and talk about stock comp and never have any real understanding what that
Damian,
feels like?
Ask Ludlow one more question, because you always ask great questions.
So Ed, should I ask Mike Bloomberg to pay me in euro or yen this year? I mean, I'm serious. I mean, look at these moves in the currencies. How does that impact the bottom line for a lot of these chip producers? Or forget about for Amazon, for any of these big tech and discretionary companies, you know, are they really thinking about the impact of these moves in the yen and the dollar?
I don't think that those names you mentioned are thinking about FX. Apple is, because Apple tried to use FX as the get out of jail card for the China decline, right? Saying that constant currency basis, the year-on-year drop would only have been 3%. It was 6%, right? And they always say, oh, well, you know, it's just a thing. The strong dollar's a thing, but
it's real.
It's real. You know, just remind yourselves and your audience, NVIDIA is an American company, and they like to emphasize that point. That's where the revenue goes to. Yeah.
This weekend, are you going to drive across the Golden Gate Bridge without touching the steering wheel?
I'm going to take another FSD 12.5 test. I might do 2. I'm thinking of going to Napa County.
Does Mrs. Ludlow know you do this?
Yeah, I mean, she's been in the car, and I've written in my column, right, that she finds it really uncomfortable. And it's really important to say that. So
that's your first nugget this morning.
Yeah.
Safe travels. Ed Ludlow.
Just to be sure, that's the car she's uncomfortable.
She finds FSD uncomfortable, yes.
Very good. Ed Ludlow, thank you so much, driving all of Bloomberg technology. Futures at negative 63. S&P futures negative 63. With our news in New York, John Tucker.
And President Joe Biden and Vice President Kamala Harris traveled to Joint Base Andrews outside Washington last night to welcome the 3 Americans who were released in a multinational prisoner swap with Russia. U.S. Marine veteran Paul Whelan was one of those released.
That's when it became real. We flew over Ireland, then Canada, and into America, and then I knew I was home.
President Biden touting the deal as the essence of who America is, both domestically and internationally.
There's nothing beyond our capacity when we act together. Nothing. Remember who the hell we are. We're the United States of America. The United States of America.
Also released, Wall Street Journal reporter Evan Gershkovich and Elsa Kurmasheva, journalist with dual U.S.-Russian citizenship, sounding more as if former President Trump won't do a debate with Vice President Harris. Trump, speaking on Fox today, said, "Why should I do a debate? I'm leading in the polls." A dubious claim. Meanwhile, Donald Trump's running mate, J.D. Vance, visited the southern border in Arizona. Vance says the reason there are so many people crossing the border illegally is because of Vice President Harris.
I think the root causes of illegal immigration are that Kamala Harris refuses to do her job. And that's what we have to focus on.
However, CBS reports internal government figures show that border crossings have dropped for a 5th consecutive month. And in sports, overall medal count of the Paris Games, U.S. 38, France is 27, China has 25. Global news, 24 hours a day, whenever you want it with Bloomberg News Now. I'm John Tucker, and this is Bloomberg. Damian and Tom.
John Tucker, thanks so much. I want to go to what is you're going to watch this weekend or think about this weekend, Damian, within the EM apple cart.
I mean, there's one thing I'm going to be looking at. I mean, tonight is Shabbos in Israel, and, you know, there's going to be some sort of retaliation.
You're looking at the geopolitics.
And so I don't think anyone's going to keep any real positioning on their books overnight because of the summer, because of seasonals, but more importantly, because of that.
Damian Sassower with us for this entire 3 hours. Stay with us from New York, Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. And with this Bloomberg Business Flash, the global sell-off in stocks looks like it's intensifying. The NASDAQ 100 index futures right now, they are sinking 1.7%. Traders worried the Fed is too slow to cut interest rates. And technology earnings also disappointing on several fronts. Amazon, those shares, they are sliding in the pre-market, down right now 8% on concern costs are rising quickly too quickly to meet demand for AI services. And then you have Intel shares. Right now they are down close to 22%. They delivered a grim growth forecast. And then the majors, the oil majors, ExxonMobil exceeding profit expectations. And Chevron had enough of the Golden State. They're moving to Houston. Their earnings also falling short of estimates. S&P E-mini futures down 66, 1.2% decline. The Dow futures down 377 points. NASDAQ E-mini futures, again, 332 points lower. That's down 1 3/4%. The 2-year yields down close to 3 basis points, 4.12 right now. The 10-year under 4, 393. That is down 4 basis points. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Damian, Tom.
John Tucker, thanks so much. Out on YouTube, subscribe to Bloomberg Podcast. I just looked at the numbers. Wow. Thank you for subscribing to Bloomberg Podcasts. We're out there with a great live chat. I have been so busy for 2 days, I haven't been on it. I promise next break, I'm on the Bloomberg live chat. Android Auto and Apple CarPlay, they're going to be out with new software. I don't think they mentioned it in the call. I asked Tim Cook. I talked to Tim yesterday, and I said, can you mention Apple CarPlay in the conference
You're talking
call?
to Tim Cook. Ed's talking to CFO. I mean, look at you two.
Damian Sassower with us here off the golf course today with lots going on. And now we're going to do something odd. We are going to actually talk about the jobs report coming up in a little over an hour. There's so many distractions, Damian. Let's bring in Yelena Shalateva at BNP Paribas with a brilliant, simple essay on 8:30 this morning. Yelena, you're going to adjust for hurricanes. Will the Fed adjust for hurricanes when they look at the data?
Absolutely. They have some smart people there working there. So I think what I will look at right at 8:30 is how much of an impact, if any, did Hurricane Beryl cause. So we may see a little bit of an impact. We may see a big one. And to me, what really matters is will the expected weakening come from that temporary disruption or from a broader slowdown in the economy.
Let me get out of the way, Yelena. The large body of people going, let's go, let's go. The laureate Krugman says now, now, now. Is there any chance with a lousy report that we get some form of Fed response, emergency rate cuts, the drama, but do they amend off a difficult report this morning?
I don't think we're going to get any emergency response. We still think that the labor market is cooling. It's not cold. Yes, we did see some signs of slowing, particularly in the ISM manufacturing report yesterday. We saw a pickup in jobless claims. By the way, that was hurricane related. I think we're still in a good place. It's, it's just one payrolls report. If it's bad, it's bad. But we still have 2 more before the September meeting. And I think, again, Powell told us they're going to look at the totality of data. And even if we hit the Sahm Rule, he dismissed it. And that won't matter much from what I understand.
Claudia Sahm with us just before the jobs report. Damian?
That's right. Yelena, earlier this month, the first few weeks of July, when Hurricane Beryl was barreling through Texas and Louisiana, were you and Carl doing high fives? Was the Fed doing high fives? Because all this means is there's going to be a lot more noise in this figure. So right or wrong, whatever decisions they're going to make in September, they can always point to the hurricane and, July and then August it rebounded. I mean, is that something that makes the Fed happy, or do you think they're a little bit, on edge because of it?
So first of all, in terms of the volatility of data in the summer months, so July is also a big month of seasonal layoffs in the education sector. So it's a really big non-seasonal drop in that sector. So we could, get a positive surprise. So it's really not a lot of volatility there. So. Because the sector is not really firing people, so we could get a positive surprise. But what I'm trying to say is that it's just 1 month, right? And whatever it is, I think the range of possible outcomes is really wide. That would satisfy the Fed in terms of this is a good enough number to continue. Just a very cautious approach.
Well, Yelena, it's just 1 month, but we've only got 5 months left in the year, and the markets are pricing in 3 cuts between now and then. So talk to us about this hurricane-related distortion. I mean, how is it going to impact the calculus of the Fed and the glide path for interest rates here in the U.S.?
Sure. So we estimate 30,000 impact from the hurricane. It's way smaller than, say, from Hurricane Harvey. We saw like an impact number of 100,000 or something like that in the previous instances. The reason is that the hurricane happened during the payroll survey week, yes, but people were still working in the beginning of the months. And, you know, BLS, the way BLS calculates these numbers is if you worked for 1 day during the payrolls period, you would still be employed for the payroll survey purposes.
Right.
So, you know, we could see some impact in construction and leisure and hospitality, but I don't think it's going to be a big one.
Yelena, thanks for the brief. I've been remiss, folks, on not covering this with the deserved focus it needs. The Jobs Day, we're doing that here in, I can't do the math, 68 minutes, I think. Yelena Shulateva with us with BNP Paribas. He just published, as Ian Lingen at BMO Capital Markets, he's absolutely nailed the vector of yield. And we're now below 4%. On the 10-year yield, 3.93%. Damian, from where you sit with 12 Bloomberg screens, is that just a bet on a global growth slowdown? Is it just that simple?
You know, it's not that simple, but yeah, I mean, if you just look at, if you decompose what comprises nominal yields here in the U.S., you've got inflation expectations, which are break-evens, and you have the real yield, right? And the real yield in the U.S. has come down 38 basis points. I'm talking 38 basis points since the 1st of July. Think about that. 38 basis points. That's roughly 18%. It's plowed through 1.8% like a knife through hot butter, Tom. I mean, it's pretty impressive, the move, and it doesn't happen every day of the week, and I think that's what markets are reacting to here.
Ian talks about, quote, a volume bulge below 4.25%. The market appears to be settling into a new anchor for 10s at 420. That's really important in your world. We've ratcheted down a 450, 460 belief, where Mr. Lingen suggests that new yield is 420.
Well, I can't wait to get Ira Jersey on the show later today, because we're going to ask Ira about Wednesday's quarterly refunding announcement, because that was critical to the move we're seeing at the long end. The fact that the Fed is going to shorten its duration, it's going to issue more bills at the expense of coupon issuance. And what does that mean for 10 years? It means there's going to be less of them out there, right? So obviously there's a little bit of a scarcity impact.
Price up, and that means yield down, right?
Correct, and that's what we're seeing a little bit.
Can you frame out, I've never asked this question, folks, in the modern age. Can we go back to negative rates? I don't need that drama.
Oh, God.
But can you frame out a 380 or a 360 in the 10-year yield?
I'm going to ask Ira Jersey exactly that question, because your guess is as good as mine, Tom. And I mean, look, I rely on Ira's estimates, when I try to, when I try to forecast what's going to happen in EM fixed income. And what's very, very interesting here, and I'm just going to point out one last thing on in my world, emerging market local yields, the only fixed income asset class, the only of the major fixed income asset classes globally to see yields rise over the last year. So if you're looking for that incremental yield, if you're looking for that incremental carry, EM local may be a place you have to now take a look at.
Look at you selling again. The only thing you're focused on in the heat and humidity of the Northeast, John, help me here. Do you get rain before, during, or after you do your first 9 holes?
It never rains in Tamarack, Tom. Never rains in Tamarack.
Really?
Oh, yeah, never. No, just, we see it in the distance. But, the horn goes off anytime there's lightning within 20 miles. So, you got to come off. But it's, gets a little
There's
old and boring.
There's your golf update for Connecticut. Damian Sassower this morning. I tell you, folks, it's been absolutely extraordinary, and I can't say enough about the team effort we've got coming up, and I'll tell you about this in a second. On foreign exchange is a litmus paper of the system, Jane Foley of Rabobank, Zach Cohen from Washington on Secretary Diamond. It's Bloomberg Surveillance for Mr. Diamonds in New York City.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. After the 2.3% sell-off in the NASDAQ, technology sent to push stocks lower again today. Pre-market, you have shares of Intel falling close to 22%. They reported a sales slump. Amazon down over 8%. They delivered a soft profit outlook. The weaker economic data pushing benchmark 10-year Treasury yields below 4%. Economists think this morning's jobs report will show an ongoing softening in the labor market. According to meeting estimates in a Bloomberg survey, payrolls probably rose by 175,000, a weaker than expected report, but likely supercharge bets on a Fed rate cut. Right now, the Dow futures 388 points lower. That's down 1%. S&P mini futures 65 points lower, down 1.2%. The Nasdaq futures right now 326 points lower, a decline of 1.7%. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Damian and Tom.
John Tucker, thanks so much. NASDAQ futures, I'm going to take this back. This is a drawdown, 10.9%. I guess that's sort of kind of like a correction on 2 standard deviations. We're almost there. And that's from the second week of July. That was the last time you hit under 90.
That's right. I mean, let me ask you this. In dollar terms, guess what the Nikkei was down overnight? In dollar terms, not in yen. In dollar terms, over 5%.
Over 5%.
Overnight.
Some reach here back a number of years, but I've even seen a statistical review of Japan going back a good 20 years on the carnage there. And again, it's not directly equivalent to the United States. I think we heard that from Anurag Rana, who was less concerned. But right now, futures, negative 63, down 1%. The NASDAQ futures down at 1.7%. We're going to go to Zach Cohen in Washington in a moment. But first, Jane Foley joins us from Rabobank because she knows the litmus paper of the system is a currency market. Jane, off the Rabobank Bloombergs this morning, what is the currency market, the set of pairs, telling us?
Well, it's telling us that there's an awful lot of volatility in dollar yen, but it's also showing us that there is a safe haven bid. The second best performing currency right now after the yen is the Swiss franc, which again shows us a pickup in demand for that, which of course the Swiss National Bank won't like, but it's got to be dollar yen. I mean, that's been stealing the limelight now for the last few weeks. It's incredible. A month ago we were above 160, and now we're down at just below 149. So huge moves for dollar yen.
For SNB headaches, and let's take that globally, and I'm going to go off Whaley at BlackRock, talking about a run rate 3% handle on China GDP growth. Do we need to consider, Jane Foley, that if there is a global tepidness, we will import disinflation and their outright deflation?
Well, quite possibly, and I think Europe is perhaps more worried about this than the US, because clearly if we were to get a Trump presidency, if there were going to be tariffs, then it is quite likely that we would see dumping of Chinese goods in Europe. But I don't think that many of the central bankers right now are too worried about disinflation, deflation. The Swiss central bank is. It has been for decades. Obviously, Japan has got a long history there as well, and this is something I think which the market failed to understand about Switzerland this year. The market was surprised twice that the Swiss National Bank has cut interest rates. And really, this is because of their history. They do not want a stronger Swiss franc. And I'm fairly certain that they're going to cut interest rates again in September.
Jane, last time one of your handlers at Rabobank was unhappy at my dumb questions. So let's go strong. Damian Sassower to Jane Foley.
Jane, I'd love to talk about Jordan and the dovish S&B, but here's what I really need to know. And I'm wondering if you could square the circle for me. Yes, the yen and the Swiss franc have been the outperformers in this move, but Asian low yielders, they're the outperformers over the LATAM and EMEA high yielders. And if you're telling me that the yen and Swiss franc outperformance is reminiscent of expectations for a hard landing here in the US, right? A hard landing, I would have thought you'd go to the high yielders as a way of sort of building in some embedded cushion into your portfolios. Instead, it's these Asian low yielders, which I would have thought would have outperformed in a soft landing scenario. Talk to me about which currencies are going to outperform in a hard landing here in the US.
Well, I think we've got to layer upon this, the safe haven bid, because if we come to a place in the world when we're so worried about geopolitical risks, when we're really concerned about what can happen on that front, then people don't worry about the return on the capital. They're worried about being able to get hold of their money, and they're worried about liquidity. And of course, that defines a safe haven. That is why the dollar, the Swiss franc, and the Japanese yen tend to do well in that sort of scenario. I mean, that's why that people often say, well, why isn't isn't Norway a safe haven because it's strong fundamentals? Well, there's no liquidity there. So we've got to layer this on top. And clearly this week we have had a lot of news regarding the Middle East. We've had that, and it's difficult really to try and identify, what are these flows are because of safe haven, and what are these about the economic fundamentals. And I'm hoping after today's payrolls data, as we walk through, next week's set of news, that we'll be able to sort of determine what sort of flows are because of the safe haven, what sort of flows are because of the change in economics.
Jane, very quick, after the dust settles, funding currencies, which funding currencies should investors be turning to when the dust settles here?
Well, again, we have to wait for the dust to settle, and this is why the yen is so interesting, because yes, the yen is a big safe haven, but at the same time, you're still looking at relatively low yields, and I think a big question mark over the trading for the end of the year is that, is a carry trade over? Well, probably not, but I think you've got to choose your timing right.
Jane Foley, if Jamie Dimon becomes Secretary of Treasury, I can't see him placing in tariffs. Can he be that important as the Secretary of Treasury to say to a president, no, we're not doing tariff idiocy?
Well, I suppose, any Treasury Secretary, any politician is going to, try and judge the way the wind is blowing. And I think there has been a certain winds blowing towards a bit more protectionism. And that doesn't matter whether or not you've been on the Republican side of the fence or the Democrat side of the fence. And I think, as Yellen, it sort of explained just a few months ago, and she would have been someone like 20 years ago that you would have thought was really going to come out and fly the flag for free trade. But she sort of explained that it's not just about free trade now. It's about maybe when one side of the party is cheating, and that's what we've got to push against. And I think that's perhaps what politicians who may have been of the free trade genre are really coming to terms with, or have been in the last few years.
Outstanding. Jane Foley, thank you so much. What a segue that is into Zach Cohen. Zach Cohen's taking notes on Jane Foley in London at Rabobank. Joining us now from Washington. And I tell you, there was a chapter at American University years ago in international studies. How do you become a Treasury Secretary? Joining us now, knowing every corner of the marble halls of Capitol Hill, Zach Cohen of Bloomberg News. Zach, is this the way people lobby to be cabinet members? James Dimon writing an op-ed in the Washington Post this morning, the next president must restore our faith in America.
Yeah, notably, he didn't say whether he thought that a Harris or a Trump administration should end up picking a so-called team of rivals that would include a member of the private sector. The important context here, obviously, being that Dimon himself might be a candidate for Treasury Secretary, maybe some other cabinet position. Former President Donald Trump told our own colleague Nancy Cook that it was somebody that he was considering for Treasury Secretary a couple of weeks ago, although he has since said that that was made up. Maybe he should check the transcript on that one. And so certainly when you see politicians, both either in the public or the private sector, try to jockey for these positions, a lot of it is done in public, most of it in private, but some of it in public, as we've seen some of with the jockeying for to be Kamala Harris's running mate in 2024.
Andrew Mellon had Warden Harding, Calvin Coolidge, and Hubert Heaver as his presidents. Zach Cohen, I'm going to say James Dimon, Andrew Mellon, but the fact is Andrew Mellon was a Treasury Secretary when a plutocracy, a Gilded Age, was expected. Can America stomach a Treasury Secretary who's a financial titan? Is the difference between Main Street and Wall Street too great?
I mean, there's certainly some recent precedent, right? During the Obama administration, we had, former titans of Wall Street, take, Tim Geithner, for instance, right, leading the Treasury Department at a really rocky time for the economy. Obviously, this was immediately after the 2008 recession, and I'm sure there are some others that I'm forgetting off the top of my head. But certainly, it's not unprecedented to draw people from the private sector. Former President Donald Trump, even Rex Tillerson, was his Secretary of State after leading Exxon. And so certainly there's some recent precedent that whoever wins the White House could draw on. And Dimon here making the case that trend should continue.
Zach, Pennsylvania's 19 electoral votes are the most of any presidential background. Talk to us about Josh Shapiro. What should financial market practitioners know about Josh Shapiro?
My colleague John Tamari, who actually a former reporter for the Philadelphia Inquirer, has a really great profile that I recommend people read. Josh Shapiro, the current governor of Pennsylvania, just elected in 2022 to that position after being Attorney General of Pennsylvania, the top law enforcement officer for the Keystone State. And Pennsylvania really is a critical battleground, not just for the presidency, but also for Senate, for House races, for control of Congress, for all of Washington, really. And, you know, a running mate is not exactly a barnstormer. You know, it's not somebody that's going to immediately bring home any state that they're from. They really only bring in maybe a fraction of a percent on a national ticket. But if Kamala Harris, you know, going into Chicago for the Democratic National Convention is looking to boost her appeal to Pennsylvania, which is this critical swing state, she might go to Shapiro, an observant Jew who is very lucid on the stump, and somebody who can really be a powerful surrogate, both in urban areas as well as rural.
Zach, I just have to cut in right there. I need you to clarify for me, who is better for Israel, the Republican or the Democratic Party?
This is really one of the critical questions, I think. And, you know, within my lifetime, there was really no daylight between Democrats and Republicans on Israel. But you see Biden and Harris really pushing this ceasefire deal on Israeli President Benjamin Netanyahu. As the war in Gaza to try to eliminate Hamas drags on, 40,000 dead, according to the Hamas-run health ministry, Trump arguing that he would have Netanyahu's back, really unquestionably. And so I think the question becomes not who is better, but, you know, who is bringing a different strategy, a different negotiating tactic with Jerusalem.
Zach, let's go to your wheelhouse. This weekend, Republicans that are our legislators, those running for office, a few still in primaries, they have to reinterpret their guy, their candidate. What is the relationship after the festivities of the last number of days between Mr. Trump and his Republican Party that you cover on Capitol Hill?
I mean, I was in Milwaukee, you know, I think I was on the show at the time, and there was a lot of excitement about a Trump-Vance ticket after Trump picked J.D. Vance, the Ohio Republican senator, to be his running mate, really a doubling down on the appeal to white, blue-collar, working-class Americans and hoping to boost appeal, especially in the Midwest, Ohio, a battleground state that has moved increasingly in Republicans' directions, trying to win Michigan and Wisconsin. But since Biden dropped out of the race, really the energy has flipped. We saw fundraising numbers for July that had Harris raising over $300 million in just a couple of weeks, which is an astounding figure, the most, I think, of any presidential campaign in American history, compared to Trump, who brought in about $130 million in the same time. A good indication that Trump has his work cut out for him to try to redefine Harris going into these last couple of months here. And so, you know, Democrats and Republicans are on recess for the whole month of August, giving us here in Washington a little bit of a break. And it'll be their opportunity to go talk to voters, hear what they're thinking, and try to make the talking points that they had been making in Washington all along.
Zach Cohen, thank you so much from Washington. The essay by Jamie Dimon in the Washington Post. Damian, I want to squeeze this in. I think it's too important. The Jerusalem Post this morning leads with a photograph of the Turkish embassy in Tel Aviv, with their flag at half-mast for some of the killings that we've seen here. That just encapsulates the tension into the weekend within the Levant.
It's a great point. And look, I mean, that prisoner swap yesterday, Turkey played a critical role there, as did others, right? And so, you know, it's kind of, it's kind of interesting where they are in all this. They're sort of taking the job up of mediator. I mean, the fact that they were home to the actual prisoner swap physically is a pretty big deal. And so, you know, what comes next for that economy remains to be seen. But, you know, what this all means for Israel, I mean, I think the verdict is still out.
Yeah. We're trying to give you economics, finance, investment, and international relations. We're doing it across YouTube. What a huge success. I'm going to find time later in the show. I want to talk about what I've discovered, which is the Olympics on YouTube. It is extraordinary.
YouTube Premium.
The shock change there. Again, we're out on YouTube. Subscribe to Bloomberg Podcasts, Apple CarPlay, Android Auto. We're within 1 hour of Jobs Day. It's Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Stock index futures indicate another lower open on Wall Street. From its July high, by the way, NASDAQ 100 down close to 9%, knocking on the door of correction. The global sell-off in stocks intensifying. The NASDAQ 100 index futures right now, they are down 1.8%. Traders worried the Fed has been too slow to cut interest rates, and technology earnings, they disappointed. Amazon.com this morning, that is sliding 8.6% pre-market trading. The concerned costs are rising too quickly to meet demand for AI services. And Intel shares in the pre-market 22% lower. They delivered a grim growth forecast. ExxonMobil exceeding profit expectations. They're on track to reach record production. And so long California, Chevron had enough of the Golden State, moving to Houston. Their earnings fell short of estimates. And right now, the S&P E-mini futures down 64. Dow futures down 344. Again, the NASDAQ futures down 340 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Damian, Tom.
John Tucker, thank you so much. Into the jobs day here in less than 45 minutes. We'll go beneath the headline data at 8:30. Damian Sassower and Tom Keene. Paul Sweeney off. Michael Barr off. Lisa Mateo off. There's a trend here. I don't know. There's a trend here. John Tucker, thank you for being here today.
I got
as well.
nowhere else to go.
Bloomberg Surveillance with John Tucker, brought to you by Interactive Brokers Portfolio Analyst. Consolidate and analyze all your financial accounts on one powerful dashboard for free. Sign up for Portfolio Analyst at ibkr.com/free PA. Let me do that again. That's a jumble. Please. ibkr.com/free FREE PA. Thank you, Interactive Brokers, for joining us. We had Yelena Shiloteva on the economics of the moment. Let's see how it folds over into the equity markets. There's been a pullback, a drawdown, almost the edge of correction. Eric Friedman joins from U.S. Bank Asset Management. I'm going to suggest, Eric, you're going to tell me this is an opportunity. When is the when of the opportunity?
Yeah, Tom, you're right. We do think this is an opportunity. We can probably hold off a little bit. Let's see if the S&P can hold a couple of key levels, the 100-day and the 200-day, which are about 3 to 5, 6% lower than where we are right now. So our viewpoint remains this. We think this is still a decent economy. We think the consumer trends are still positive. Again, there's some differentiation across consumers. And finally, capex, we still think it's positive. Last thing I'll say is this. Ultimately, this is about companies really forcing themselves to focus on shareholders and shareholder value. We think that continues through dividends and buybacks. So we would use this as an opportunity, but you can probably wait to be a little more selective than right here, right now.
Damian Sassower publishing moments ago, David Rosenberg in Toronto, Rosenberg Research. He says simple recession label all over the July ISM index.
Ooh, interesting. Look, I'm looking at the 10-year, Tom. Eric, I'm looking at the 10-year at 394. It's a heck of a lot easier to get long duration at 4.25. What are your thoughts there? I know you guys have been kind of pushing out along the curve. Is that something you're still looking to do?
Yeah, I think around here, we'd probably tap the brakes a bit, Damian. And also, hey, you did a great job. Your Wednesday piece is a must read for folks on the emerging shifting of risks in FX.
Thank you.
So we do think that the yen move, we think that the move in Japan is definitely something to pay attention to because that has to play out. So ultimately, again, at 4.25, 4.5, that's where, adding the duration looks interesting. We're going to stand pat here, see how things play out. I think the key thing for us on a risk measure beyond what you've aptly covered, Damian, on currencies is credit. That's the thing that people are really not talking about.
Yeah.
We just haven't seen a confirmation of the quote unquote recession that's been, we've been waiting to have happen for years now. It's not really showing up in credit. Until it does, we still think this is an opportunity to keep involved in risk assets.
This is what I love, folks. I got two adults from Global Wall Street going at it, and they're coming up here with some really nuanced insights. Damian, you go to Eric, but I'm asking you a question right now.
Yeah.
We all know the Japanese bond market's been a fiction
Yeah.
because the government crowded out the private market. Do you see that unwinding?
Have you seen the curve in Japan? Have you seen what happened? Look, they hiked rates and the curve is yields are down across the board in Japan. So that just shows to the sort of deficiency of that market in terms of, right, it's
Can they
all
unwind
BOJ
that with stability? I'm asking for Eric Friedman.
Well, let's ask Eric Friedman. I mean, Eric, here's my other question for you also. It's an interesting one here. I mean, I know that commodities have long served as a hedge against inflation, but I'm looking at the BCOM index. I'm looking at energy prices. I'm looking at everything but gold. And it looks like, maybe now is a time to maybe be kind of towing in if maybe we got ahead of our skis here and inflation is something we still need to be worried about. What are your thoughts there?
Yeah, two things. One, just on the Japan piece, absolutely great points Tom made. I think that the key with Japan and Japanese bonds is that 85 to 90% of the holders of Japanese bonds are either Japanese citizens or Japanese Treasury officials or corporations. It's just not a widely owned set of paper, and it's something that we look at, but we tend to pass just because the nominal and real yields are just so low. I think in terms of the commodity piece, as I shared in my speaker notes, this is a spot that we traded out of. We think our logic is good in the sense that this is likely an inflationary policy set coming from both either Vice President Harris or former President Trump in terms of who's next. But the market's saying, hey, what's happening in copper, what's happening with the base and the industrial metals, it's too early. So I do think selectively in places like gold and silver, worthwhile. We do think that maybe owning a little bit of Middle East optionality through crude makes sense. But owning the broad index, we think you can wait. We're, again, below that 200-day moving average. There's been some real distribution. Probably a chance to step in, but just not quite yet across the broader index. We'd be more selective.
Tom, what Eric's saying is so very interesting. I mean, he's really looking at commodities, the asset class, is really a hedge against inflation. Quite frankly, that's the way the market's been viewing it. But I wonder, Eric, if there's any fundamental sort of driver underlying all this. I mean, China is what I'm thinking here, right? I mean, everything about commodities is what's coming next from China, demand from China, demand from China. Any thoughts on China?
Yeah, I mean, we're underweight China, Damian. It's something that we think China's going to keep running the old playbook of printing capital, injecting liquidity, and again, trying to export their way out of what is a very structurally difficult position, which is lack of consumer demand and upside down property market. There are some things that China has in its favor, but again, that demand, I think that the old Larry Summers note of from a couple of years ago around the mean reversion of Chinese growth, that we think is going to be a durable phenomenon. So we're not as bullish. We think that it's probably more of a trading market as opposed to an investing market. We're underweight. We're going to likely stay that way until there shows some signs of more structural reform, which we're not holding our breath for right now.
What do you do with big tech? I mean, just as a gross basis at U.S. Bank, what do you write for big tech Monday morning for a broad set of clients?
Yeah, I think the biggest thing, Tom, for us is that because we are relative return investors, we have three choices: neutral, overweight, underweight. We're really neutral on big tech right now in terms of like the Mag 7. It's not our favorite moniker in the world. But we do think that benefit towards focus on capital over labor will play out over 3, 5, 7-year cycles. Again, you do a great job of talking about the parlor games that exist in our industry. We think that structural bias towards companies really focusing on big data, really focusing on cyber, and obviously focusing on what we're seeing in AI, that continues. That's a durable theme. Probably overhyped near term and probably underhyped long term. So we do think that being at least market weight's the position to be in. We'd probably start nibbling a little bit further down, but we think being dramatically underweight over a 1, 2, 3 year time frame is probably one's peril.
Folks, I know that's sacrilege on a Friday in August, not with a 3-minute perspective, but a 3-year perspective. Eric Friedman in U.S. Bank as well. Damian, I think that's a critical issue here. People do analogs to 1999 and all that. I think the trading perspective now has been even more compressed, where 3 days is long term.
No, exactly. I mean, all Eric was really talking about there are some key technical levels and the fact that you kind of got to wait and see. And that's the same thing Jane Foley said. And so you know what I see? I see an opportunity to take advantage of option markets to maybe, I know vols come up here, but maybe you got to buy some protection here ahead of what is going to be a seasonal slowdown and a very volatile one at that.
Let's very quickly here, we'll address this later. The VIX from 16 out to 20.64. That signals a new volatility.
Yeah. Oh, absolutely. Well, maybe you write calls then, right? I mean, that's a way to protect, but you don't want to sell your shares. I think that's what Eric was saying. You don't want to sell your Mag 7, your Elite 8, your Fabulous 5, whatever you want to call it.
Did you see the Tom Petty video at Fenway Park?
I love Tom Petty. Yeah.
It's great. Should be in the Smithsonian. Great video. Tom Petty at Fenway Park. Check it out on YouTube. We're on YouTube as well. Mr. Petty.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
We're addicted to the parlor game, the Fed, the monetary ballet.
Where do you see opportunities in that fixed income space here in 24?
With Lisa Mateo on markets.
AI affecting demand for cloud computing.
And Michael Barr with news.
Another legal setback for Donald Trump, this time across the pond.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good morning, everyone. Paul Sweeney, Tom Keene, Michael Barr, and Lisa Mateo. Selected few are off today. John Tucker saving us from oblivion today. We'll get to him in the market moves here in a moment. And the markets are moving. Futures at negative 1%. NASDAQ futures again out near 2%, negative 1.8%. Damian Sassower in for Paul Sweeney today, which is perfect timing given the global upsettedness that we're seeing here 29 minutes away from a jobs report. For Global Wall Street, a real treat, Katie Kaminsky with us in a moment. Damian, what's a trend? Kaminsky's all trend. We're not stochastic. We're trend. What does that mean?
Well, I think trend means, you're going to have to see a mean reversion move here. And look, that's what makes technical levels so very important, and even more so in the slowdown in the summer. But if you just take a step back and you look at what's going on across the board, it's not just the U.S., it's not just Europe, it's Asia, it's the whole world. Yields are coming off. Everyone's getting long duration. There's a bid for fixed income, and it's basically making the case that maybe there is a safe haven bid here. A little bit of ballast in your portfolios might not be a bad thing.
Shout out Bruce Kasman, JP Morgan, with a note 2-3 weeks ago, disinflation in the win. We're on YouTube. Subscribe to Bloomberg Podcasts out on YouTube. You search YouTube, Bloomberg Podcasts. You'll get there. There's a picture of Lisa Mateo and all. Apple CarPlay, Android Auto as well. With our Bloomberg Business Flash from the Interactive Broker Studios, John Tucker.
And the futures indicate lower open on Wall Street. NASDAQ futures down 1 3/4%. If that holds up in today's trading, the NASDAQ will be officially in correction. S&P E-mini futures down 60 points. That's a decline of 1%. Dow futures right now 305 points lower. That is down 0.75%. Weaker economic data pushing benchmark 10-year Treasury yields below 10%, below 4%, 393. That is down 4 basis points. The more policy-reactive 2-year yield, that is down 3 basis points at 4.12, ahead of the 8:30 jobs report. Bloomberg economists, surveyed by economists, say probably the payrolls rose by 175,000, a weaker than expected report, likely supercharging bets on Fed rate cuts. And in the pre-market, shares of Intel 23% lower. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Damian Tom.
John Tucker, thanks so much. Joining us now, Dr. Catherine Kaminsky, Chief Research Strategist at Alpha Simplex. Katie, that PhD from MIT, to get through the gate, you have to take what's called, this is torture.
Oh, God.
The general examination. Students are required to take the general examination once they're given the process to be considered for a PhD in operations research at MIT. Katie, what was the general examination like at MIT?
Oh, it was long. You spent the whole summer just doing optimization and probability problems. And the exams are 5+ hours each.
Yeah.
So a lot of math fun. I loved it.
Yeah, my father went through the torture as well as you. 5 hours of math and probability and combinatorics there. Give us the probability right now of this market. Have we broken trend?
Yes, we have, especially in the shorter term windows. If you look at the S&P 500, it's broken its 50-day moving average. The NASDAQ has broken some of its 100-day moving average. So you're definitely seeing some huge shifts in trends. It's been a difficult summer to be a trend follower, I'd have to be honest with you, because we've seen a huge shift. And whenever there's a shift, there's noise, which is tough for, predicting trends.
Katie, everyone likes to talk about equities, equities, a correction equities. I want to look at fixed income here. I want to look at the Bloomberg Global Aggregate Bond Index. It hasn't been up not one day this year. It's been in negative territory all year long. And guess what's going to happen at the close of business today? It's going to be up for the first time this year. Talk to us about bonds. Talk to us about the bid for duration.
This is a really important point because we have been very stubborn bond bears for almost 2 to 3 years. And this is really, really connected to this inflation story and rate hikes, and then eventually at some point cuts. And what you've seen this month is that net signals in fixed income have turned the corner and have moved to positive. And this may be an indication that the market has shifted away from higher for longer to we need higher rates because we're concerned about the economy. And the data is starting to come in a little bit concerning, and risk off and risk on behavior might come back into play.
Let me go to the two of you. I'm on two heavyweights here, Katie Kaminsky and Damian Sassower. I'm looking at the Bloomberg Aggregate Bond Index breaking out price up, yield down. No one, Damian Sassower, is talking about going back to ultra low yields.
That's right.
Is that in your universe as you publish?
Let's remember that non-dollar bonds comprise more than 50% of the global aggregate bond index, right? So it's not just treasuries. We are talking JGBs. We are talking, bunds and bobbles and all that good stuff. So, I mean, what's really interesting here is the FX impact. It's sort of this perfect cocktail where you've got the dollar sort of weakening but staying robust, and you've got yields coming off across the board.
Katie, take the perfect cocktail here that Damian describes and go to the unimaginable. I'm not talking drama like negative rates, but are we prepared for price up, yield way down?
I think it's going to take time, but I do think if we have a big move or if we have a recessionary environment, it's very common in trend following to see strong long signals in bonds, and also we're going to see some short signals in the commodity sector. So we could see a big move if there was a strong enough recession.
Katie, does the coupon income accruing nature of fixed income contribute to the durability of those signals you're seeing in terms of trend following?
In some sense, yes, because obviously carry is a big component that affects trend. But we're definitely seeing that right now it's been interesting because you've seen pretty flat yield curve. So it's going to be a question of what happens next. And we're seeing stronger signals long on the long end of the curve, which to me suggests that that is sort of the long-term direction point, but I think the way to get there is still going to be a little bit turbulent.
Katie, I don't bring it up on air because semi-logarithmic charts on radio really don't work. But Katie, if I go to logs and I look at some of these linear functions, I'm starting to see some serious convexity and accelerative tendencies. Is there a lot of convexity out there that could lead to bigger, larger moves, like in VIX coming out 16 to 20? Can you model out a vector to 25 or 28?
Yeah, so what happens oftentimes with trends is that you'll see sort of they stay within a range bound. It's as if the market's like saying, are we moving to a new equilibrium? And when we get some sort of confirmation, then you can have that convexity come in where it's really not a linear move. It's a much more nonlinear move that causes a massive repricing in markets.
Interesting. I have to ask you this. I know it's a little bit out of your remit, but I'm looking at some of these emerging market currencies like the Brazilian real, which was, you talk about carry. That was the currency you wanted to carry in, right? That was the one. It's almost at an all-time high. I mean, talking dollar real here, it's lost everything. I mean, it's almost at an all-time high dollar real, which means that the real has been depreciating relative to the dollar. Talk to us about the carry trade. Do you still see some legs left there?
Well, the carry trade has been very volatile. I mean, there's also been idiosyncratic things like what happened with the Mexican peso. So I think the sort of juice in the carry trade has gotten very turbulent because of all the changes in monetary policy and all cuts on the horizon. So there's sort of some anticipation that there's going to be volatility. So that classic carry trade, because remember, carry does well when things don't move. And they're moving.
Katie, one final question quickly here. Do you see trends in commodity? Is there something Alpha Simplex sees in the commodity vectors?
So commodities have been very tricky because they did sort of a double dive, right? So you saw copper go way up and then come back down. That was keeping us thinking about inflation. You also saw gold has been sort of one that's been stickier. Agricultural commodities have definitely been more on the short side more recently. But in general, in the last few weeks, risk off has been running commodities pretty strongly.
Katie,
so downward signals.
Katie, thank you so much. Thank you for that vignette back to the Massachusetts Institute of Technology. strategy. Katie Kaminsky, Alpha Simplex this morning. Futures at negative 56, exactly. Futures at negative 1%. With our news in New York City, John Tucker.
Hi, Damian and Tom. President Biden celebrating a major win in global diplomacy. The president was at Joint Base Andrews outside Washington last night, as Wall Street Journal reporter Evan Gershkovich, Marine veteran Paul Whelan, and journalist Alsu Kermesheva came home. More from Bloomberg News senior editor Bill Ferries.
You saw them finally land on U.S. soil, shake hands and hugging President Biden, Vice President Harris, and their families. And really, yeah, I think the kind of scene that every president works hard for.
Bloomberg's Bill Ferries. The three Americans part of the largest prisoner swap with Russia since the Cold War. And President Biden says it couldn't have gotten done without support from foreign governments.
Toughest call on this one for other countries, because I asked them to do some things that were against their immediate self-interest, and really very difficult for them to do, particularly Germany and Slovenia.
Also at Joint Base Andrews, Vice President Kamala Harris. Now there's news from Harris's campaign that she raised a record $310 million in the month of July. Harris's haul more than doubles the nearly $139 million former President Trump raised last month. Meanwhile, Donald Trump says that right now there's no reason to take part in a presidential debate against Vice President Harris. During an interview on Fox today, Trump said, "Why should I do a debate? I'm leading in the polls. Everybody knows her. Everybody knows me." Well, Trump has agreed to 2 debates against President Biden when he was leading in the polls. However, a recent Reuters Ipsos poll shows Harris with a 1-point lead over Trump. Sports. Simone Biles winning her second all-around Olympic gymnastics title. Meanwhile, swimmer Katie Ledecky winning her record 13th medal with a silver. And as for the overall medal count at the Paris Games, the U.S. has 38, France 28, and China has racked up 26 medals. Global news, 24 hours a day, whenever you want it with Bloomberg News Now. I'm John Tucker, and this is Bloomberg. Damian, Tom.
John, thanks so much. Whole new world after all. I discovered this last night. I have YouTube Premium, which I really recommend. Love it, love it, love it. Of course, we're out on YouTube. I've staked my entire career on the future of YouTube. Damian,
yes.
So Mrs. Keene and I wanted to look at the triathlon, idiots swimming in the River Seine. You go to YouTube, and you get a 6-7 minute, gorgeously edited triathlon summary, including them running with barefoot. I thought that was interesting. And it's on YouTube, no ads, no up close and personal, just expert analysis of the actual race.
I mean,
it's nirvana.
So you're going to watch the U.S. women's national team tomorrow take on Japan. We're talking about Japan all day. Of course they'd be playing Japan tomorrow. So you're going to be watching that on YouTube Premium.
I'll wait and watch it on YouTube rather than the agony of being told that I need to buy Maybelline mascara to lift and separate my eyelashes.
I agree with you. Well, look, I'll be watching.
This is the future.
My son, I mean, all we do is we pay for his YouTube Premium. He's down at University of Miami. That's the only thing he watches. Everything's on YouTube now.
Really?
Cut the
That's
cord.
An important anecdote.
Cut the cord,
Does he subscribe to Bloomberg Podcast?
He could even get NFL games, I think, on YouTube and like live across the board. So, I mean, it's the way to go.
Is the brat subscribed to Bloomberg Podcasts out on YouTube?
Of course he is.
Of course he is.
Regularly.
Okay. You can stay for the jobs report. Damian Sassower, thank you so much. In 15 minutes, an important jobs report. And as Yelena Sholoteva said, perhaps affected by the hurricane. From New York City, this is Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. And with this Bloomberg Business Flash, investors waking up to a slower economy. Tech-heavy NASDAQ heading toward correction territory. Right now, NASDAQ E-mini futures 1.7% lower, down 324 points. S&P futures right now 61 points lower. That's another decline there of 1.1%. The Dow futures are down 345 points. Look at the 10-year yield, almost 4 basis points lower ahead of the job report, below 4% at 3.93. Well, 374 companies in the S&P 500 have reported earnings so far. 79% of those companies are delivering positive earnings surprises. Intel right now facing the biggest share slump in 24 years, down 22% pre-market after reporting their sales slump. After Amazon's results, Amazon shares down 8.3%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Damian and Tom.
John Tucker, thanks so much. Brent, I agree with you. Brent out on YouTube live chat. Quote, YouTube Premium is so nice. That's exactly right. Nicely said. I got it. I had no idea what to expect. And like the moment I got it, Damon, I could tell it was like it cleaned up, clear, smooth, effervescent. Like you said, your son lives on it. Right?
He does. And look, I mean, the reality is, I think a lot of people don't know which way to go, which way to turn now in this environment of cord cutting. But I think YouTube is probably as good as it gets, at least in my opinion, what I've seen.
Yeah, we're going to see on that. Claudia Sahm will join us here into the 8:30 report. But we really wanted to crowbar in here the most important person in the building. Mandeep Singh came from the industry. He is part of the fabric of Silicon Valley. He chose a different path to join Damian Sassower at Bloomberg Intelligence. And we're going to talk now about the Singh Rule. The Singh Rule is follow the dollars, which is follow the capex. Mandeep, I want to focus here on what you learned in this tech earnings season about the nature and character of capital expenditure.
Look, you're right. I mean, there is still that fear of missing out in terms of Gen AI and how undersupplied this market is. And that's why we saw every company raising their capex, barring Apple. And, Apple has a different strategy when it comes to deploying AI. But all the other hyperscalers talked about raising their capex for the second half and 2025, and all of that is going towards deploying generative AI.
Right. All my viewers and listeners, their radar goes up maximum when some Yahoo like you says, we have to spend money because if we don't, we'll fail. Come on. Do they have to spend money on capex, or can't they ease it up and extend out the x-axis?
Well, typically there is a digestion phase. Things never go up in a straight line where, you just keep spending without any ROI expectations. But right now we are in that phase of this investment cycle where ROI expectations can continue to be muted because that fear of missing out, and the disruption to your business is so big right now that every company just wants to chase it. And I think to an extent, we have seen some popular use cases, Microsoft, Copilot, Meta applying generative AI to their family of apps. So it's not that we have not seen any proof points, but clearly there is a much higher level of investment going on than the revenue that's being generated.
Well, Mandeep, I think you would agree that question was better directed at one Mr. Rob Schiffman, who covers credit for tech here at BI, and he could tell you that a lot of these companies have borrowed quite a bit of money and they need to put it to work. But my question for you is about Amazon. This is a company that has generated a positive return in 12 of the last 15 years, at least. I mean, every year I'm looking at it, it's up, and it's up big double digits. It was up 80% last year. It's up again this year. Should we use this correction to load up on Amazon, or do you think there's more downside here?
So with Amazon, I think they had a mixed quarter, but the real difference between an Amazon and the other mega caps is in terms of capital allocation. Amazon still doesn't have a dividend. They're still not that big on buybacks compared to, your Alphabet, Meta, and Microsoft. And that's where the capital allocation does make a difference. I mean, Apple, look, they're not spending on capex, but we know they spend big on buybacks. And that's where it makes a difference to an investor holding one of these mega caps. What is your priority? And I think with Amazon, you will have that roller coaster where they will be big on operating income, but then they will miss and they will just say, we are investing right now.
Mandeep Singh, thank you so much. Too short a visit today. We got to get you and Anurag Rana on. They're not allowed to be in the same room.
No, I know that.
They're going to be separate.
They actually aren't allowed to be in the same city. They moved down here out to Chicago.
Yeah, no, they have to be separated. They're so important. We'll get them on again. Okay, a couple years ago, here's the abstract. This chapter proposes a direct payment to individuals that would automatically be paid out early in a recession and then continue annually when the recession is severe. The outcome of this paper, direct stimulus payments to individuals, she will be hounded forever about the Sahm Rule. We are honored on this Jobs Day to have Claudia Sahm join us out of Michigan, off the Fed, of course, with New Century Advisors, definitive and without question, the most followed economist in America today. Claudia, I don't want to get into cute, trite stuff. I'm not going to do the usual media interview. But what is the use of your rule, the wiggle room that it has? I think of DSGE, which can go 8 ways. How many ways can the Sahm Rule go, or is it ultra rigorous?
It's a tool. It was part of a policy proposal, an idea to do more fiscal policy, put it together ahead of time, design it well, tie it to economic conditions, take some of the politics out in the crisis, and hit go. Right? It was a tool to solve a problem. In the past, we haven't fought recessions as vigorously. It was developed before COVID, and so that's the idea of it. It's not. And it's a tool. It needed to be simple. It needed to summarize a lot that was going on in the economy. Frankly, we have an economy right now that's extremely hard to summarize. So it's having a rough go of it. And yet I'm glad it's being helpful, I think useful to some extent in the conversation right now.
To the data certitude that's out there in your classic paper, folks, seriously, the paper was out of Brookings Institution was iconic. You cite Johnson Parker. And in that paper, they say, wait a minute, do we really know what we're looking at with the consumer? Just as a general statement. Does Claudia Sahm feel a certitude to the present data, or do you feel like it's squishy and we're really not certain where we are in our labor economy?
So I was raised well as a real-world macroeconomist, and I don't look at anything with certitude. I think that's exactly when we get ourselves in trouble. And yet I do know when I'm confused or when I'm saying this doesn't make sense or what could be wrong here, I just dig deeper and deeper into the data. And I've spent a lot of time under the hood of the Sahm Rule trying to figure out what's going on in the labor market. And I think that's what we have to do. We've been proved time and again wrong over this entire cycle. This really has been different in some ways and yet not entirely different. So you don't want to ignore all the signals.
Claudia, the Sahm Rule is a recession indicator, not a recession forecast. Talk to us about false positives. Have they happened before, and can it happen again?
What the Sahm Rule is, it's taking into account this momentum that we can often see happen in the labor market into and through a recession. So small increases in the unemployment rate, they get to a certain point, they're bad news, and they end up as big ones, right? Like I didn't invent this. Like this has been a dynamic we've lived with for generations in the U.S. economy. What I did with the Sahm Rule was say, okay, I put a really high bar. Like we are in a recession. It has happened with high accuracy. And that's why, like on average in the past, when the rule has triggered, we have been 3 months into a recession. This is not a forecast.
Claudia, we're so honored that you're with us today. Claudia, I want to go back to Claudia Sahm of Michigan, or Jonathan Parker, Merton professor at MIT. He's absolutely iconic on the data mystery that's out there. The media spouts data certitude. I say, no, it's not. When you see the jobs report here in 4 minutes, how amendable is that as a tool for economists? Amendable, how is it used as a tool for the Fed?
The data, they are the starting point, should ground all of the analysis. One thing that economists, we have to really guard against is having our tools, our theories, and then if a data point comes out and we don't like it, we just explain it away, right? And there's been a lot of really confusing data to try and deal with and change. So it's a real balancing act, and yet you can't just follow the number, right? The data point dependency gets you in a lot of trouble, right? You got to think bigger and tell the story.
Quickly here, did you hear data dependency certitude in the Powell press conference?
They're walking the fine line. They are trying. I think what's hard is you have a humility that your model, your tools don't work the way they did in the past, and yet you're still trying to put together ones that do work on the fly. And that is a really tough balancing act. They're trying to do it. I don't agree with how they're putting all the pieces together, but I see them pointed in the right direction.
Claudia Sahm, please stay with us. Claudia Sahm here with New Century, and we'll come back and look at this jobs report. It's a very tough thing for Dr. Sahm. We're going to go into the report, look at the headline data as well. I used to say, Damian Sassower, that with the jobs report, I immediately went to the duration of the unemployed, the median number of weeks unemployed.
Okay.
But that was like a recession thing, and we haven't had that.
Yeah.
We've had a pandemic stimulus in that. And I guess you do look at the unemployment rate, which pulls into Claudia Sahm. What do you as a quant look at when you look at the jobs report?
Birth, death, labor participation. It's all about the numbers,
you're
right?
with
I'm a
Anna
card
Wong on
counter.
birth, death.
I'm a card counter, man. I mean, so look, I am not a U.S. economist by no stretch of imagination. Am I accurate in this? But if you give me a deserted island, you ask me what data points I'm going to use, it's going to be the number of unemployed. Yeah, the actual numbers.
What a joy yesterday to have Anna Wong of Chicago with us, with Richard Clarida, the former vice chairman of the Fed. And I thought they were piercing on her really industry-leading discussion of birth, death. I know you were in a golf course.
No, I was listening. Anna's at 146. She's at 146 for what are we, 5 minutes out? 2 minutes out. She's at 146, so she's below the market, below consensus at 175.
We'll have to see on that as well. Really can't say enough about the set of data we're going to see here. And of course, it goes on to 10 o'clock with the oddity of durable goods and all today as well. But coming up on the jobs report, again, Claudia Sahm will join us, and then Neil Dutta afterwards as we see this important report. The previous number, and again, I'm very revision oriented, was 206,000 with a very Anna Wong-like negative revision last time around. And as Damian mentions, we go 206 to a more diminished 175. I know Claudia Sam's listening, so she's going to insist I say that the standard error around that 175 number, and I'm going to use a Michigan word here, it's ginormous. Okay, the standard error is ginormous. So if it's 175 down to Anna's, 145?
Yep.
That's not that big a miss. Or if it's 175 up to 210, 220, it's not that big a miss. And yet we're all hanging on.
Everyone's going to blame the weather.
With futures at negative 56. Let me go to the yield space right now. The 10-year with that recent shock, 3.93%. The 2-year, 4.10% as well. I insist we quote the real yield, the 10-year real yield, 1.76. That's in a solid 3 basis points this morning. That's important. Wow, 1.76% there. Again, there are two jobs reports, the non-farm payroll report and the other report is showing the unemployment rate modeled at 4.1%. And of course, we're looking at the wage data as well, which is looking for a little bit of a more quiescent inflation. Let us look now at the jobs report of America. Coming out now, and it is a huge depression. It is a woe statistic as well. I'm going to go through this for a bit before we go to Claudia Sahm, and we're going to see major market moves here. S&P down 75 points right now. NASDAQ down 1.9%. There goes
the 10-year, 382.
382. Wow. The 10-year yield off of the numbers, which I'll give you in a moment, folks. The 10-year's in 17 basis points for global Wall Street. I'm not kidding. Ginormous fits the Friday morning tone, 3.80%. Here are the numbers, and I have the revisions now. The revision is a weaker statistic from 206 down to 179. The summed revision is negative 29,000. The non-farm payrolls is 114,000, below Dr. Wong's statistic, below the survey of 175. The unemployment rate explodes is too much, but hey, I'm in the media. 4.1% to a higher level, 4.3%. We'll have Claudia Sahm speak on this here in a moment. Tepid earnings on a month-over-month basis, which is what Ira Jersey looks at. It comes in weaker, 0.3, becomes 0.2. Weekly earnings, a revision weaker. The actual statistic, 3.7, becomes 3.6. You get the tone that we see out there. Labor participation actually is somewhat constructive. The underemployment rate, Alan Greenspan's favorite statistic, explodes is the correct word. 7.4% to 7.8%. Rich, do we have Dr. Sahm there? We do. Thank you, Rich. That helps a lot. The VIX out two big figures, 2.29. S&P futures at negative 87. Claudia, Sahm, I've got to ask the media question. Is the Sahm Rule in force at this moment?
It triggered. Yeah.
Wow.
Yeah, so that puts it up over its 0.5 percentage point threshold, noting that comes off of historical experience. That doesn't necessarily tell us where, we are right at this moment, saying a recession. This has seen way too much momentum in the unemployment rate in recent months. 4.3%, right? This is not, so whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market. Right, we have seen potential. All is not lost. We are, the bottom's not falling out. We should never panic. There are policy tools. There are levers, and again, I don't overread one data point, but this isn't one data point. So I think the case now for, hey, we're normalizing. We did need to slow things down some, probably, generally speaking. But now the question is, okay, so we've had enough slowing here. What levels this out? And that, I think, I don't have the answer for that.
Claudia,
I think that's the big one.
An economist of merit, Claudia Sahm, by the name of Stanley Fisher, once lectured me and other worthies that the percentage move is important. The fact is we've gone up 0.9% from a 3.4% unemployment to a 4.3%. And that percentage change is ginormous. I'm going to give that to you folks in a moment. This is something you can do on the Bloomberg. It's actually way, way cool, to say the least. We've had a 26% increase in the unemployment rate, pandemic adjusted. I get it. How does that fit into your historical perspective, Dr. Sahm, on a move in the unemployment rate?
We have had a lot of disruptions in the labor force. So the supply of workers, you even go back to the beginning of the pandemic, millions of people dropping out, and then we had labor shortages, and then we had larger immigration coming in. This has just been a lot. And we all know personally, and then also in the economy, adjustments can be hard if they are big and sudden. And we've had a lot of that. And so this is absolutely in there in these increases in the unemployment rate. We are still working through disruptions. And yet, underneath that is also a much more typical, pernicious, not good, increase in the unemployment rate of just there's less demand for workers. And if workers don't have paychecks, they can't spend. And then that's the momentum that gets going. So the volume is turned up louder than usual on the Sahm Rule. So I don't look at this and big picture say we are in a recession, but I look at this and I say we're we're not headed in a good direction.
Damian, get one more question in here. She has to speak to President Biden here in a moment.
Claudia, I'm a huge Guns N' Roses fan, and I love the song Patience, but waiting for waiting's sake is no way to conduct policy. That's not me, that's Neil Dutta. Talk to us about what happens in September now. Is this enough for the Fed to move?
Fed should have moved.
Should have moved already.
This was a discussion, and it's a discussion. I have been in the Fed needs to start. The rest of the economy was normalizing. The rest of the economy was cooling off. The Fed needed to do the same thing.
Okay, but Claudia, I'm going to go, Claudia.
But all is not lost. And they have a lot of lever to pull.
Claudia, I got Neil Dutta coming up. Okay, Damian nailed it. Okay, let's just forget process. We're out of a pandemic. Everybody, Krugman's going now. Dutta's going now. Sam's going now. Do they have to save face and wait till September 21? Or can they come out and go, when the facts change, we change, like Bill Dudley? And I'm sorry, make the adjustment at 4:30 p.m. this afternoon. Why not, Dr. Sahm?
They have an ability to do whatever they think is appropriate. In no way, shape, or form do I think panic should be the theme for today or for any day of the Federal Reserve, frankly. And they will need to assess the situation. And this was not good data in the let's wait. But again, this is not overreacting. You can't go back and redo policy decisions. They have a lot of tools at their disposal, and we should be very thankful that there are these policy adjustments that can be made. That will help.
Claudia, thank you so much. Honored you could attend this morning. Dr. Sahm, without question, the most influential economist in America right now with New Century Advisors. We turn to Neil Dutta, who's lost patience. He has an optimism on the American economy, and he's really pulled back and said, let's go. Where is the Dutta optimism this morning, Neil? Help me out here. I need to be optimistic. Where are you optimistic on the American economy?
Well, if you wanted me to say something optimistic, I'd echo what Claudia said. So thankful to be on after her. Quite an act to follow. Thanks, Tom. But I would just say that we don't need a troubled asset relief program. We don't need a resolution trust corporation. I mean, the problem with the economy is that monetary policy is too tight. And that means that looser monetary policy can help resolve the problem. And so, from my perspective, the Fed can just keep cutting until the economy turns. And there's a lot of room for them to do so. So I think that would be the optimistic sort of spin on things, is that, the Fed has plenty of ammunition to kind of, course correct here. I think they'll use it. And, this isn't about household balance sheet deflation. This isn't about corporate balance sheet recessions like '01. This isn't about an asset bubble bursting. This is just about monetary policy being too tight. The writing has been on the wall for months, okay? I mean, this sort of let's wait, we get, spooked by first quarter data and waiting for the sake of waiting. I mean, this is what happens when you play that game, okay? And look, I mean, I agree that it's not worth panicking, and I don't think that this means that the Fed should move intermeeting or anything like that. But let's be absolutely clear about why this is happening. The writing has been on the wall for months. They didn't have a story to tell for why inflation would pick up.
That's right.
Every single monetary policy rule that they look at, that's in their monetary policy report every time they go before Congress, has been saying the same thing for months, which is a less restrictive policy stance is required. Now we're going to act all surprised when, the labor market's slowing in a more material way. And I will say, I mean, I do think it's going to get worse before it gets better, because when you look at some of the details within this report, goods producing industries saw a pickup over the month, Tom. Construction employment rose over the month. What do we know about residential investment over the summer? It's going nowhere. So the Fed's been kind of playing this game of chicken with the corporate sector where, the data has been strong. And so the Fed feels like they don't need to move, but the data's also been strong because the corporate sector thinks it's going to move.
Let me get a data check in here. And Damian wants to crush you. The VIX, folks, at 20 level, out to a 21.26. And Miletti's aged off that. 2.67 full points here on the VIX. We're now negative 97 on the Standard & Poor's 500, 1.8% down. NASDAQ down 2.57%. Damian says, I don't care about the equity market. I'm looking at bonds.
That's right.
10-year yield for I'm looking at the 30-year bond, thinking it's a 10-year.
You're missing the big one here. You're missing the big one here. Dollar yen down 2.5 big figures to 147.40. A stronger yen.
Dollar weaker because they think the Fed's going to cut.
So Neil, I have to ask you this: traditional safe havens. No one likes bonds. No one likes gold. No one likes the yen. But look at what's happening here in this market. But some of these moves are pretty big, and it is obviously an illiquid summer. Are some of these moves overdone, or is there more to go?
I mean, I think it's probably overdone for now, but I wouldn't be like selling fixed income here just because we had a sharp move. I mean, I think, you probably take opportunities with yields going up to kind of build on your position. I do think that, like I said, I think the data is going to dictate a lot of these sort of, high frequency moves. And like I said, I think the data is going to look worse before it looks better. And so I think for me, that means there's additional, like something like downward revision, something Tom's been talking about. We know that downward revisions have a momentum to them, right? So the fact that the numbers are being revised down kind of sets the table for the sort of direction of travel. employment data.
Yeah, we heard that from Claudia Sahm as well, and to have Sahm and Dutta with us is great. Let me tell you, folks, we are commercial-free across the nation to the end of the hour. Ira Jersey will join us now. He's publishing Bloomberg Intelligence, their interest rate outlook. We are thrilled that in moments we'll have Ann Miletti with us from Allspring Global Investments on the value that's out there as we see a dearth of growthiness this morning. Right. And with us right now, Neil Dutta, futures at negative 100 on the Standard & Poor's, Dow futures at negative 525, and again, the VIX 21.43. Damian to Mr. Dutta.
I'd like to ask you about that dearth of growthiness, Neil. I mean, that's a great way of putting it. The 10-year real yield down to 1.69%, off another 7 basis points on this news. Talk to us a little bit about, I mean, it's sticky here in New York, right? It's hot outside, but sticky inflation seems like it's a thing of the past now. If I never hear sticky again, that might be too soon. Talk to us about inflation. Is that something we have just no interest in anymore? Is it all about growth in this market?
Well, I don't have any interest in inflation anymore. I think that was last year's story. It's a bit ridiculous. Again, Damian, it has to do with what's the mechanism, right? Unit labor costs have been below 1% for the last couple of quarters. I mean, for crying out loud. Where's the inflationary impulse? The inflationary impulse from the labor market has been non-existent, in my opinion, for at least 3 quarters, 2 to 3 quarters, okay? The Fed is just now saying that. So, I think this is really a function of, number one, they were spooked by the first quarter data, even though they didn't understand why it rose. It rose, and they sort of took more signal from that than they should have. It was more noise than signal. And they're allowing, the specter of the 1970s to haunt them. But the key distinction between this period and that period is that was a period of falling productivity growth. This has been one where productivity has largely been normalizing.
That's the key. That's Neil, I got to interrupt because that's the absolute key insight right now. I don't know which war they're reliving, but they're reliving a new war because we have new productivity. We talked to Clarida. It's pretty good. You have Richard Clarida, Bill Dudley, Claudia Sahm, and Neil Dutta. I mean, that's a group of economists. Give one more to Dutta here before he goes and works.
Well, Neil, it's a new beta regime for sure, but, the old playbook seems to be kind of working here. Investment-grade credit just crushing on this move in U.S. Treasury yields. And if you're right, and there's, not that much wrong with the corporate sector here in the U.S., is that a fixed income asset class that you want to own right now?
Yeah, I mean, look, like I said, I think, just to take it back, we have a period of pain, I think, ahead of us. I mean, the next few weeks could get bumpy unless there's some kind of surprise Fed meeting. I don't think they'll do that because I think that might invite more panic than it's worth. But the Fed is going to get eventually on the right side of the 8 ball here. There's absolutely no reason to worry about inflation at the moment with the unemployment rate rising, unit labor costs slowing, oil prices collapsing. I mean, it's just a ridiculous thing to be even considering.
Right.
So that means I think the Fed is going to, start to, unload the cannon a little bit. And, for Wall Street, I think, what I'll be telling my clients is 50, 25, 25, 100 basis points of rate cuts straight out the gate. I think the Fed has the space to do it, and I think that's the prudent approach at the moment. That's the prudent approach.
20 seconds, Neil Dutta, because Ann Miletti's going to walk out of the studio if I don't get to her. When you say 50, you're the first person to say this. Do they signal 50, Neil Dutta, or do they keep it a surprise and shock us September 21? I say they signal.
I mean, they should signal it, but I think more importantly is the guidance. They should say that they're willing to do what it takes to stabilize the unemployment rate, provided that inflation continues to slow.
Neil, thank you so much. It's great to have Claudia Sahm and Neil Dutta with us with this report. And again, futures at negative 93, Dow futures negative 466. Ann Miletti with us here. She wanted to go, she's in Milwaukee. Did you survive the convention in Milwaukee?
I did. I stayed kind of far away from it.
You couldn't even get to your offices, right?
Well, luckily, we are still in the suburbs in Menominee Falls, so I didn't have to, but we're moving downtown.
How do you, I'm so honored you're here today because we're doing traditional long-only buy-side. We're trying to do a short-term 3-year view, and you can hear the cacophony here from Dr. Sahm and Mr. Dutta. How do you use what you're hearing right now?
Yeah, well, you've had, some of the smartest people on the show already this morning, and it's really interesting to hear what they had to say. And certainly we pay attention to the macro, to the top down. But what's been maybe more interesting to me as an investor is the signals that we've been seeing from the bottom up, right? Looking at companies, listening to what they've been saying and telling us, and there certainly has been signals, and we're seeing it in the reporting season. We've seen it not just in the numbers, but more importantly in the outlook, and those cracks really are real.
Yeah, well, consumer spending and whatnot. But I'm looking at other data points. It depends which data points you look at, Tom. This credit card delinquencies look fine. I mean, I know the consumers hurt, kind of taking it on the chin a bit here, but fundamentally things seem to be fine here in the U.S. Is there room for people to buy the dip here?
One, I think people tend to panic when they see moves like these. I think it's actually healthy because you had something priced into the market that likely was not sustainable. And the more we take out here, the better chance we have of not having a big disaster when things change. And so there are opportunities. Volatility brings opportunity. We're going to see more volatility.
We're going to see more volatility. We got a VIX up 21.41 right now, folks, back to almost an August normal, given the sweat of August over 3 decades. And Miletti, Intel's adjusting. Okay, let's call it a train wreck to be polite. But within the securities analysis at Allspring and the legacy of Milwaukee Strong, how do you adapt to the revenue shortfall? Church & Dwight, toothpaste, baking soda, came in with OSG, organic sales growth, a little light today. Citigroup went to a sell on an iconic New Jersey company. How do you adapt to the new revenue tepidness?
Tom, I think one of the things that you talk about a lot, which I think is really important, it's more than just earnings, right? It's been top line growth. Top line growth has been tepid, to say the least, for the majority of the market, except for kind of those concentrated names that we've seen. And so when you see deceleration of growth, it's a sign. That's what I meant from those bottom-up cycles, or the bottom-up signals. The opportunity set, though, that lies in front of us is there's still names in each sector, not in all, but like most sectors, that have been washed away, that still can outperform in a changing market.
Let me do a reset here, folks. If you're just joining us, a difficult and challenging jobs report. You heard on Bloomberg Surveillance, Claudia Sahm, formerly with the Fed, the Brookings Institution. Claudia Sahm saying her Sahm Rule is in effect. She said that the moment after this jobs report, with week revisions as well. Futures, not as bad as they were 10 minutes ago, negative 85. The VIX is going to give me 3 big figures right now, 2.71 figures. 21.24 on the VIX as well. The 10-year yield is what Damian Sassower noticed in 10 basis points now. Excuse me, I'm still looking at the 30-year bond, Damian. My brain's failing.
It's coming back.
3.84% on the 10-year yield right now. Damian Sassower to Ann Miletti of Allspring.
It was a lot easier, Ann, to get long the 10-year when it was at 4.25 just a few weeks back. Now we're at, 380 on the 10-year. I mean, talk to us about duration. Talk to us about the demand for incremental yield in the fixed income market. Does that make sense right now?
I think it does. I mean, one of the things that we put out in our Outlook piece going back at the end of last year was this was going to be a year for fixed income. We also kind of warned about some softening of the economy. Now, look, we're mid-summer or late summer, and we're starting to see these turns. But we do think that there's been opportunity. Our fixed income teams have been increasing duration. And, kind of believe that this would be the environment we would see. And so I think there still is opportunity out there. You just have to pick your points, to Neil's point earlier.
One final question. I got 20 seconds. What is the quality of a first place Milwaukee Brewers?
I mean, Tom, I'll take it. But as you know, it's still early in this season. And so we'll just hold our breath and cross our fingers.
Hold our breath. 565.
How about that contract for Jordan Love, though, huh?
I mean,
let's go Green Bay.
If we could actually get 3 all-star Hall of Fame quarterbacks in a row, I mean, it would be a miracle. But
okay, there we go. What
it.
matters? Miletti of Wisconsin, thank you so much. In Milwaukee, legendary at Strong, and of course with Allspring Investments. Coming up, the Secretary of Labor, Julie Su, will join us at 9:02 as our scheduling there. Catherine Greifeld and Anne Marie Horton leading that conversation with the government on this difficult labor challenge. Joining us now, and Damian, I want you to lead off here with Ira Jersey.
Love that.
And I want to explain this, folks. A lifetime ago, you had on the desk at Credit Suisse a guy named Dominic Constam and a young lad, Ira Jersey.
Young lad.
And they were read voraciously on the street for times like this. Why don't you go to Ira Jersey on the love fest we see in fixed income?
Ira, the Fed has been in a deferred asset position for the last 22 months. That means it receives less coupon income than it pays out on its bond holdings. Talk to us about this quarterly refunding announcement. Talk to us about the Fed potentially issuing more, or the Treasury issuing more T-bills than coupon. Talk to us about the reserve repo facility. Talk to us about what's going on the front end here.
Wow, Damian! I thought we were going to talk about the 378 target that we just hit on our on one of our charts that we published.
Thank you for highlighting that, Ira.
One of our CMTs, and we bounced right off of that, and it's right now.
Yeah,
it's
but
holding.
I'll do that in a moment. But Damian's asking the pro question. Into the weekend, Ira, what's liquidity look like?
Yeah, so liquidity in the Treasury market is not terrible, right? Treasuries are still one of the most liquid assets, but relative to where it was, when Dominic and I were on the trading desk at Credit Suisse a decade or so ago, it was definitely it's definitely weakened since then, and there's a couple of reasons for that, right? One is yes, the Federal Reserve is running off its balance sheet, but one of the big changes that's occurred in liquidity and in the front end in particular is the fact that you have different repo products, right? So you just don't have a market, a funding market that's kept up with the size and growth of the amount of treasuries out there. Plus you have regulations like Dodd-Frank is a non-trivial regulation as well, because now you have less relative value players in the market. You don't have hedge funds who are trying to clip a basis point and a half in relative value between off the run and on the run treasuries in the same size that you used to have, because the leverage just isn't available, thanks to prime brokers and the like not having the same balance sheet capacity.
Over the weekend, for our listeners and viewers, they're going to look at their CD and say, why didn't I lock in? With this move in the 10-year, will we see cash in America look for a new spot come Monday?
Yeah, I suspect that people are terming out some of their shorter term assets, and they will do that, particularly, I don't want to say the smart money, but away from retail investors. And that's one of the reasons why something like 2-year notes are going to catch probably even a bigger bid than you've already seen, because you're going to have people saying, okay, look, I'll lock in 3.5% now because in the future I might not be able to get that in my money market, right? So you wind up with people terming out their debt. Now, interestingly, at least in the near term and from relative value, something like the 5-year sector might actually outperform, because the market's going to keep on adjusting to where the terminal rate of the Fed is going to be. And one of the things we've been harping on is the 3.5% that persisted for the last 4 or 5 months. We thought was actually too high. So that's one reason why we think that the front end is going to even do better than it has so far.
Damian, get one more quick one in here.
Ira, 2s10s, 9.4 basis points, negative 9.4. We are almost to positive territory.
Wow.
I mean, talk to us about the curve. What should we be looking for there?
Yeah, so continued bull steepening of the curve. It won't be a straight line, right? We'll wind up getting a okay data report at some point, and we'll probably bounce back and people take off those trades. But we'll continue to see that curve slowly uninvert. Again, this is like a leverage issue, because right now, since the Fed hasn't actually cut interest rates yet, right now those curve trades are very negative carry. So you have to have high conviction to stay in the bull steepener right now.
Yeah.
But I think you can have more and more conviction, and that will occur. Particularly after the Fed finally, makes its first cut. And it looks like now in September is almost a shoo-in.
Ira, thank you so much. Ira Jersey, who will publish this afternoon, look to Bloomberg Intelligence for that, a required read for a weekend global Wall Street. Major shout out to our team for setting this up today. What an honor to have Claudia Sahm with us and then Neil Dutta, and to have Ira Jersey with us and Ann Miletti to give us some equity perspective as well. Where we are, well, we cratered at 8:30. We've come back a little bit. I don't want to be too inflammatory. I've got futures at -78. I've got Dow futures at -438. NASDAQ 2.1% south. Bitcoin flat. How about that for a rock of stability? Lots coming up here. Stay with us. Another hour of Bloomberg Surveillance on YouTube, on Apple CarPlay, on Android Auto. Good morning from New York City.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Are these stocks under-owned by institutional Wall Street?
A lot of these companies talking about generative AI.
With Lisa Mateo on markets.
Investors just worried about the ongoing sales slump in China.
And Michael Barr with news.
A ship traveling through the southern Red Sea has been attacked.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Lisa Mateo. A hellacious week of news and, of course, a jobs report that shocks America and shocks the Fed. You heard Claudia Sahm on Bloomberg Surveillance say the Sahm Rule is in effect. A busy half hour here. Ethan Harris to join us, the Secretary of Labor. First, John Tucker with our Interactive Brokers Business Flash.
All right, Tom and Damian, the stock sell-off intensified after the jobs report. The real eye-popper, the yields, the more policy-reacted two-year yield, 20 basis points lower, 394. The 10 continuing its dive below 4%, down 12 basis points. That's at 386. NASDAQ E-mini futures down 2.25%. If that holds up today, the NASDAQ will be in correction territory. You mentioned Ms. Sahm on the program earlier with the unemployment rate rising to 4.3%. This is on a rounded basis. Her Sahm Rule threshold climbing 53 basis points. So that has been triggered, suggests a recession might have already started. Right now, the Federal Reserve, the market interest rate cut betting, pricing in a greater chance of a 50 basis point reduction for the September meeting, plus more than 1 percentage point of easing by the end of this year. And you mentioned Wall Street's fear gauge popping higher, the VIX up to over 21. And Hurricane Beryl, no discernible impact on the employment and data for July. Tom and Damian.
John Tucker, thank you so much. Julie Su is from California, and she is someone who has been acting Secretary of Labor, but very much fully in charge of labor. There's the usual ballet in Congress as well. It has been a joy, but under the stress of this labor report, Julie Su with our Catherine Greifeld and Anne-Marie Horton.
And radio audiences, because joining us now, I am thrilled to say we have Acting Labor Secretary Julie Su, along with our own Anne-Marie Horton. And it's great to have you with us. Obviously, a big reaction to this jobs report. So we had a 114,000 increase in payrolls. You actually spoke to us back in June and said that we were looking at the definition of a soft landing. As you parse through these numbers, would you still say that today?
Hi, thank you. It's so good to be here. I mean, we, look at the 3-month average. The 3-month average in growth is still 170,000 jobs. Remember, we spent a year talking about how the numbers were too high and too hot, and we had always planned for a transition to a more sustainable, steady level of growth. This number did come in below expectations. It's still over 100,000 jobs. It's still broad-based. We saw growth in multiple industries. We saw it in construction. We saw it in healthcare. We saw it in leisure and hospitality. There was a dramatic drop in one industry, information. But generally, this is an indicator of continued strength in the economy. And when you look at other things, including labor force participation, which is at an all-time high for prime age workers. And we continue, know that there's continued work left to do to make sure that we maintain a strong economy. But we're still at a 3-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
The unemployment rate came in at 4.3%, and Claudia Sahm has already said that this has now triggered the Sahm Rule, which basically means we potentially are on the cusp of a recession. How concerned are you in the White House about that?
Well, we're not concerned about that specifically, in part because the unemployment rate that it grew from has been so historically low and has been so historically low for such a long time. I believe even Claudia Sahm herself expressed some questions about whether the rule applies when you start at 4% or just above 4% unemployment rate. So again, we have to keep in mind, these numbers come in not in a vacuum, but as part of a overall picture of an economy that we've been talking about for some time that did not happen by accident, that was not inevitable, in which there's been tremendous growth and an economic recovery that is, frankly, the envy of the world. And so we know that the work is not finished. We know that you don't get. We don't stop doing the work that we've been doing. But one example of the effectiveness of the president's economic policies is that some of the growth is being driven by private investment into areas in which the president's Investing in America agenda has brought in public investments. And so those investments continue to hit the street. We'll continue to keep delivering them in different communities, and we'll continue to watch the numbers.
And of course, we're continuing to watch the numbers. We're also watching the stock market reaction right now because we're seeing a big wipeout in futures. And the conversation that's happening among investors, among market participants, is this concern that the Federal Reserve is behind the curve, that they waited too long to cut interest rates. Is that the view of the White House as well?
I mean, we don't comment on Fed policy. I know they have, they've indicated plans and what they are likely to do. We still believe that this is an economy that, again, did not recover by accident, but also is one that reflects, the Biden-Harris commitment to working people. The real wages remain up over the year. They're still higher than the rate of inflation. This, as I've said over and over again, means more money in the pockets of working people. And some of the story that's not part of the labor market data is that we continue to see more workers join unions, more workers reach first union contracts, more contracts result in record wage increases. Those are all further indicators of what we believe is essential to a strong economy, which is that working people do well, working people share in the profits that they help create, and working people get a voice at the table.
We had Governor J.B. Pritzker, though, yesterday talking about the loss of manufacturing jobs in Illinois, calling on the Federal Reserve to move. If the White House is not going to take a stance, I imagine more Democratic leaders are going to come out and also say that this partially may blame the Fed because it is an election year and they don't want themselves to be blamed. How concerned are you that Fed potentially acted in a way that means that more Americans would be losing their job?
I mean, manufacturing is a good example, right, of something President Biden has said from the very beginning, that we need to bring manufacturing jobs back to the United States. We need to make sure that the iconic industries like the auto industry that have powered this country's middle class continue to do so. Illinois is a place where, due to the UAW's historic contract, the president and I traveled to Belvedere, Illinois, talking about factories that are going to open that have been closed for a really long time. These reversals of decades-long trends that were not good for workers, that were not good for unions due to failed policy of the past cannot be reversed overnight, but we are seeing movement. And so that progress.
But Julie, many industries barely grew. Manufacturing, retail, information, all negative over the last 2 months.
If you look at manufacturing since President Biden came into office, those numbers are up, and there's continued investments that we are making. If you look at construction jobs, those are also up. Those are two areas in which, again, federal investments are helping to drive that change, helping to drive that growth. And so we don't make too much of any one month, but when you look at the trend, those are both sectors that are up. Doesn't mean we don't have more work to do. Doesn't mean there aren't communities that remain devastated from failed economic policies of the past, that have failed working people, that have left working people behind. We remain committed to doing that work, and the overall numbers still demonstrate growth there, and we'll continue to put dollars into communities to rebuild them and bring jobs back.
And parsing through these numbers, it did seem that manufacturing payrolls did add 1,000 jobs last month. But to Anne Marie's point, that comes after 2 straight months of declines. I want to talk about revisions here, because on the top headline number, there was another revision to last month's number. And we've seen that increasingly over the past several months, that the prior month's numbers are revised down. And I'm curious what your thoughts are as to why that dynamic is unfolding. Because, again, the question among investors is, how do I trust these numbers?
Well, you noted at the top that this month's revisions were fairly minor. Revisions, I always say this too, are a feature of the numbers, not a bug. It's not an error. It's basically continuously these numbers get revised because it's the trade-off between getting out numbers quickly and getting complete numbers. So to get the numbers out every single month, as we do, it requires a certain amount of projection. And then once the real data comes in, because these are these aren't just numbers, these are actual people, right? They're people who respond to surveys. They're people who answer questions. They don't always answer them at the time that I come here to talk about it, and that's why we revise when we get the more accurate numbers. That has always been the case, and that is why the BLS data is the gold standard when it comes to labor market information.
If we have 4.3% today, where do you see the unemployment rate year end?
Well, I'm not going to make a prediction about that, but I will say, again, we look at everything in the context of the whole. And so GDP remains very strong. Layoffs remain relatively low. The labor force participation rate remains high. All of these are counter indicators. They're not indicators of recession. And so, of course, we keep an eye out. Of course, we have to keep on doing the work that we are doing. And you know, we do want the economy to reach a state in which there's more steady, stable growth. And the, you know, 114,000 a month, you know, there were, in the last administration, 7 months of numbers that were less than 100,000. And so, again, we're in a transition period. We've always said there would be. That was part of the plan. This number is cooler than expected, and so we have continued work that we need to do. And the investments in the President's Investing in America agenda are going to be really key to continue to power our strong economy.
Well, we have to leave it there. Really appreciate your time on this busy morning. Our thanks, of course, to Acting Labor Secretary Julie Su and, of course, Bloomberg's
Anne Marie Horton and Catherine Greifeld with the Acting Secretary of Labor. 40 minutes ago, Claudia Sahm said on air, the Sahm Rule is in effect. There will be no other topic this weekend in academic and market economics. Expert on this, carrying an Excel spreadsheet, a tattoo on his left arm, is our Michael McKee as well. Why is there a debate about the usage of the Sahm Rule?
Are you worried about your audience? Because this is just so technical, it's going to drive people crazy. If you look at the 3-digit unemployment rate, it was 4.253, not 4.3, but it gets rounded up into a 2-digit rate.
Right.
If you use 4.253 and put it into the Sahm Rule calculation, you only get to 0.485. If you use 4.3, a 2-digit, you get to 4.
So the debate this weekend about Claudia Sahm, most influential American economist right now, no question about that, is a debate about decimal points.
It's a debate about decimal points, and it's really it's really meaningless. It's the angels dancing on the head of a pin.
I love it. I love it. Now, let's talk about meaningless. I'm watching the Fed press conference. Colby Smith's there with the FT. Leisman's sitting there talking about measured in Greenspan, and you're sitting there with steam coming out of your ears because this is a Fed that's completely ex post and data dependent. How does an ex-post, data-dependent Fed adapt to the jobs report we just witnessed? Don't tell me we need more data.
We need more data. No, I just wanted to do that to push your buttons. But that's what they'll say. We need more data. This is a very sharp deterioration in hiring, but it's a deterioration that they had expected.
Yes.
We're down close to the level that would be that you would need every month to absorb new entrants into the labor force. So that's kind of what they've been aiming at. It just happened all at once. So that's going to be a concern. We are above the level of unemployment that they forecast for the end of 2024. So that's a concern. The good news in this is that wages, the wage level went down. So the Fed sees that as more sustainable. And they'll say, we want to see more data, but they'll also say, we told you that if the economy went this way, we'd cut rates.
One more question, because we have to go to Dr. Harris. And this goes to what I talked to Richard Clarida about, and I'm going to speak to Ethan Harris about this, folks, in a moment. I would respectfully suggest, in honor of Daniel Kahneman and Tversky, we're living a massive regret aversion. We're massively on our behavioral economics. We have an institution scared stiff of their regret of the past. Is behavioral economics at play here?
Well, I don't want to psychoanalyze them, but
that's my job.
I think that they are definitely influenced by that. And it's not even the distant past. It's not the Volcker years. It's January, February, when they had said they were going to pivot, and then all of a sudden inflation went back up again. So they're trying to be very careful about it. But this is all psychological in the long run, because, it doesn't matter whether you trigger the Sahm Rule or not. It's what markets think is how they're going to react.
You're going to have a relaxing weekend?
I'll be stressed thinking that I'm not relaxing.
There's that too. Well, welcome to Economics. Michael McKee, thank you so much, providing leadership to all of our economic coverage. It has been an extraordinary week for me and the team. What they've done with the Fed decides to have Bill Dudley with us, the former president of the New York Fed, the honor of Richard Clarida, the former vice chairman of the Fed, not once but twice, is now topped with Ethan Harris. He wrote one of the most penetrating books on a Fed in change, in transition. Ben Bernanke's Fed. He was iconic at Lehman and at the Bank of America. We're thrilled that Dr. Harris could join us this morning. Ethan, I slotted this in as a 3-hour conversation, and that got nixed by the Harris household as well. How does a Fed get out of this position? Do they wait for September 21? Do they jawbone it in speeches? What's the process you see with your study, the history of the Fed that they put in place to September 21?
Well, the Fed has been very lucky for the last couple of years, and suddenly their luck has turned dramatically against them. They were ready to cut, and then inflation comes in on the high side, and they go, whoa, wait a minute. Then they have a July FOMC meeting before they see the jobs report, and jobs report comes in very weak. And so now, in hindsight, they probably wish they had cut at the July meeting. But going into that meeting, given the forecast for payrolls, nope, not going to do it. I think they have to start talking. It's very hard in August because most of these guys are out on vacation. I think earlier had mentioned that the board seems to be all out on vacation. But they need to start talking. They need to signal that September's definitely happening.
Ethan, I got to get one question in here because Damian Sassower, you should see it, folks. I'm sitting in our radio studio here, for those of you on radio, and Sassower's literally writing his must-read EM, economic and financial note here off of this jobs report, which is actually, it's how the sausage gets made at Bloomberg. Ethan Harris, I brought this up with Richard Clarida, Columbia Economics, and it's simple here. I see massive regret aversion. We got comment of Tversky 101. They're really, really concerned about making a mistake. Do you sense that?
No, I think Mike had said this earlier in response to the question, that they certainly at this stage think they're behind the curve. But given the information at hand, no. Let's not forget, the first 4 months of this year, you had terrible inflation data. It wasn't just a little high. It was running at double the rate they wanted to see. And so it put a big, it really put a whole halt on the whole idea of rate cuts. Now they've gotten, the script is flipped very fast. So, I do think that they worry about the credibility of the Fed. We know that in the 1970s, the Fed made massive mistakes around inflation. We know that this Fed started to hike too late in 2022 and had to catch up. So yeah, there's a little bit of that legacy. You don't want to be remembered as Arthur, you want to be remembered as Paul Volcker, but within the scheme of things, they're a little behind the curve. They'll catch up.
Right.
I'm confident in that.
Ethan Harris with his folks, of course, at Lehman and the Bank of America for years, actively out on LinkedIn. Can't say enough about that. To reset here, futures -100, down -66, improving futures. We are commercial free from before 8:30 this morning. We thank our sponsors for that and their great support. No more than on this day of economics, the economic indicators at Bloomberg Surveillance, always brought to you by Commonwealth. Join over 2,000 independent financial advisors taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to Commonwealth.com to learn more. And again, Commonwealth, thank you. You're the backbone of our economic coverage. Damian to Dr. Harris.
Dr. Harris, I was reading your note from earlier this week titled "Slow and Steady Wins the Race." And I mentioned earlier, I'm a big Guns N' Roses fan. I love the song Patience, but you have Neil Dutta talking about 50 basis points in September, and you're saying the Fed's behind the curve here. Is there a chance that the markets start pricing that in more confidently?
Well, they have. By the way, Neil and I worked together for quite a while. He's a good friend of mine. And I think this is a good, healthy debate. I think I was wrong. I think this jobs number to me was a bit of it kind of hit me pretty hard. It's looking on like things are weakening faster than you'd like to see, and it's the payroll number that I'm most worried about. It's just this is starting to look shaky. When they go 50, well, the market's now pricing in about a 70% chance of a 50 basis point move at the September meeting. That's a really high probability. Yeah. You really have to believe the economy's heading into a recession to get the kind of cuts that are priced into the market now. Now, I think the risk of recession's rising, and that slow but steady story's getting is losing its validity. But to go 50 in September, we're going to have to see an even worse jobs report and continued soft inflation readings. So I think the market's overreacted. It's pricing in a Fed going at every meeting, including this 50 basis point kickoff cut. It's just the bond market overreacts, and today I think it's an overreaction.
Tom, you notice how Dr. Harris remembers working with Neil Dutta, but he doesn't remember working with me at Lehman Brothers back in the early 2000s. Thanks about that. Thanks for that, Dr. Harris. Yeah,
I'm just trying to forget. You cut his bonus in February 1.5 years.
I mean, come on.
Single-handedly did that.
Dr. Harris, talk to us. I mean, there's a lot of ambiguity here about where U.S. Treasury yields are headed next, obviously. But the consensus seems to be that we're going to have a steeper curve, certainly 2s, 10s. What are your thoughts here? Curve is now at, -9 basis points. I mean, are we going to get there sooner rather than later?
I think over time the curve has to steepen. I mean, the risk premium priced into the bond market is crazy low. The bond market's pricing in no risk of inflation going forward, no term premium. It's just a matter of when. Now, of course, when the Fed starts cutting, it helps steepen the curve. But there's a more long-run story here, which is just that the curve doesn't make any sense.
I mean, Ethan, they're coming out of the woodwork. Not only is Neil Dutta emailing in, Robert Sinch is emailing in. He's even more retired than Ethan Harris. Sinch.
He can't be more retired than me.
Bob Sinch really makes the important observation, a la Anna Wong, that we got birth-death issues. And let me quote exactly Robert Sinch. There is a residual seasonal adjustment problem. Ethan Harris, are we going to have all this data amend us down, as Anna Wong says, 30,000 non-farm payroll?
Yeah, I think that the estimates of modest kind of continued revisions where they go back and look at whether they're counting workers right and taking into account births and deaths of companies, there'll probably be some downward revisions. But the question is, are they going to justify a recession call. And that's a long way. I mean, we've been getting payroll numbers of 200,000 plus. I don't think you're going to revise that away. But they could slice, some tens of thousands off of these numbers. And we may find out with the benefit of hindsight that the economy had slowed a lot more than we thought. Certainly that's what the unemployment rate's saying. It's been going steadily up. Some of that may be because the job market is a lot weaker than we think, and some of it's because of labor force coming back. But yeah, I think there'll be some downward revisions, and history will show this was a softer period than we thought.
Ethan Harris, my people will be in touch with your people. We're pulling you out of retirement. We're looking for a weekly slot. Ethan Harris, author of Bernanke's Fed. We're waiting for Jerome's Fed, Powell's Fed as well. But Ethan Harris there, of course, with the Bank of America years ago, as was Bob Sinch and Neil Dutta, Lehman, and Damian Sassower is well.
When I talk about a residual, I'm a residual from Lehman Brothers, I can tell you that.
How do the other developing economies in EM and indeed frontier economies, how do they adapt to finally of an America taking a pause?
Well, it's interesting. I mean, what we're seeing is actually them finding a bit of religion. I mean, just this week, Chile, they didn't move on rates. Brazil, they didn't move on rates. I mean, next week we have Mexico. The market is pricing in a 25 bip cut by Mexico next Thursday. We'll see if they deliver.
Stan Fisher, 1998. Does this limit the degrees of freedom that EM has?
Absolutely.
Absolutely.
No, but here's the thing. I mean, if Mexico does decide to move, I mean, they'd be they'd be a little bit of an anomaly here. I mean, I don't expect them to do that, but the market does, and we'll see. I mean, I think you really just have to take stock of where we are here, and rate differentials are still very, very wide relative to the U.S.
15 seconds. Is there leverage in the EM system now like there was in 98 or in 92?
No, not at all. Certainly not like that. No. In fact, I would argue that positioning is very, very light, and it doesn't take a whole hell of a lot to move the market.
I had to do that. I had to get Ecuador in just to make the day go. An extraordinary day. We have to get the markets open now. Thank you to all. We continue. This is Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom, waiting for the opening bell. Traders slashing interest rate expectations after that pretty dismal jobs report. It triggered the Sahm Rule, raising recession fears, yields tumbling, come back some, the 2-year, 18 basis points lower. That is at 396 right now. Right out of the gate, stocks are lower. The S&P 500, 78 points lower. That's down 1.4%, 53.68 on the index. The Dow Jones Industrial Average, 1% lower, down 381 points. The NASDAQ 100, the tech-heavy NASDAQ 100, down 400 points, down 2.1%. If this holds up, we will be in correction for the tech-heavy NASDAQ. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Damian and Tom.
John Tucker, thanks so much. If I don't talk to you again, what a week. Take the weekend off, John.
There's always next week.
There's always next week as well. Bloomberg Surveillance, brought to you by IBKR Financial Advisors. Switch to Interactive Brokers for lowest cost, global trading, and turnkey custody solutions. No ticket charges, no conflicts of your interests at ibkr.com/RIA. And I can assure you, and I speak for Paul Sweeney, that we are just humbled by our benefactors, IBKR, Commonwealth, the Resco and Resnick, for their support that makes us go every day. This has been an extraordinary Friday. And with Damian Sassower, it gets stronger. Max Kettner joins from London, and I can't say enough about the heritage of the Hong Kong and Shanghai Banking Corporation from David Bloom, Dr. King, and others over the years, with really spearheading smart research. Max Kettner, the foundation of that has been Steve Major, like John Templeton, saying there will be a bid to fixed income. Once again, Steve Major looks smart. Yep. How does your multi-asset world change given new major low yields?
Yeah, I think probably in terms of the data right now, it's probably a bit of an overreaction. I think when we talk about, still above 100K payrolls data, to square that with a recession is perhaps a bit overblown. In fact, when we look at some of the cyclical data in the US, it's been pretty okay. Look at GDP for Q2. Look at the reporting season for the second quarter. We're talking about 14% earnings growth.
Yeah.
Particularly driven by some of the cyclicals. So, I think some of those fears, particularly around a 50 basis point rate cut, or even the possibility of an intra-meeting rate cut, some of those fears are a bit overblown. I do think we're a bit in an environment where it's a bit like sell first, ask question later.
I love that, Max. And what's important here is you have to do your analysis. What will you look to see stability away from the gloom? What will you try to observe from London?
Yeah, I think part of it is really on the front end of yield curves where now there is way too much priced in. So there's perhaps a few signs of stability there in terms of the pricing. That really would help. That certainly helps. I think some stability also on the Japanese yen, which of course comes then in tandem with the stability on the front end pricing, and in particular also some more encouraging data. I think really markets have been very, very fixated on bearish readings right now, even with a reporting season that has been on aggregate really just fine, but we've been really, really focused on the negatives, really focused on this really, really negative or perhaps misses on the earnings releases. So I am waiting for perhaps a little bit of just stable data, which already would be enough to take that wind out of the sails for those ones who are pricing 50 basis point of cuts.
Max Kettner with this HSBC down negative 500. John Tucker noting the convenient 10% correction. Damian Sassower, to Max Kettner's point, can I point out on a weekly chart, the NASDAQ is just back to my support? It hasn't even broken long-term support yet.
See, I can't believe you're looking at equities.
Because it went up that far.
You're still looking at equities. I mean, I'm a big baby. Max Kettner, I have to just chime in here. If you've ever golfed with me, which I have to have you up to Tamarack to do, I'm a big baby on the putting green. I always leave my putts short because I'm a big baby. I'm scared. When I'm scared, I like to go to safe haven assets. But as we know, in this beta regime, treasuries, the yen, the Swiss franc, they really haven't been acting like it. Talk to me about gold, all-time high right now. Talk to me about where you want to hide out in this market.
Whoa, more than that, 2,500. Thank you.
Thank you.
Max, please.
Please.
There we go. I think commodities are actually still a pretty good space, right? So we are still overweight overall in commodities. I do think not only gold, but also others. The slump in energy prices and some of the metals that we've seen, that could be, from a diversification perspective, also pretty good entry levels. Because look at the last 6 months, for example. Everyone's been sort of moving in tandem. Of course, people are complaining when yields go up and equities go down at the same time. So if everything sells off, but let's face it, in the last 2 months, lower yields have helped equities and spreads and all of that. And people weren't really complaining. But, from a diversification perspective, that, of course, is anything but ideal. So we do need a bit of hedges and a bit of stuff that is moving in a different direction. And really, the only place where you can find it right now is gold, is also other parts of commodities, energy, base metals. So that really is one of the few diversification areas that are left.
Negative 493 on the Dow, SPX down 90 points, NASDAQ 2.46%. Some of the story stocks out there, Amazon down 10% right now, a little bit painful off of their tech report. Thank you, Anurag Rana, for perspective there. Damian, Intel shares, they plunged 26%.
Is that right?
The biggest drop since you opens V. Bodie's corporate finance in 1982. On a standard deviation, I'm doing this only to impress Max, from a July 20 peak, Intel is down wow. I can't even do the math. It's such a big
so
number.
many zeros.
It's down 6.5 standard deviations.
Oh, wow. I mean, look.
Should I sell?
Well, I don't think Max would have you so, but Max, I do have to ask you this. We've had a bunch of people on today. I mean, you're in the Eric Friedman camp that, there is some value to commodities, that they do indeed still serve as an inflation hedge. But we had Neil Dutta on, and he's like, sticky inflation, forget about it. That was last year's story. Should we still be looking at CPI, about inflation gauges? Does that have any value in this beta regime after what we've just seen this morning?
Yeah, I do think so. I think we're probably burying the inflation theme a little bit too soon. I think 2-3 months ago, I would have said, yeah, you know what? We're probably on the other extreme. We're getting too worried about inflation. Right now, however, look at short-term inflation expectations. A 1-year CPI swap or 2-year break-evens. They're comfortably below 2%. Actually, the monthly fixings are pricing headline CPI to go almost to 1.8% by the end of the first quarter next year. So frankly, fine, that may come. It's fully in the price. Whereas if we do see some categories, right, like house prices that have gone up over the last year and a half, if that feeds through into higher rental inflation, goods inflation that is heavily negative right now, some of that disinflation running its course in the next few months. Then, of course, things like, one-off effects like perhaps vehicle insurance, which actually fell into disinflationary territory, that perhaps picking up a bit again. So only a tiny whiff of an inflation upside surprise, I think would totally take the market off guard here.
Max, is this the end of carry? I mean, let's be clear. The G10 FX carry index is down 1.5% in July, yet it's still up 5.5% year to date. It's still the best of the 21 Bloomberg GSAM FX strategies we follow here internally. Talk to us about carry in the current environment. Does it still have merit?
Yeah, I think in the near term, it's really challenging because let's be honest, most of that has been financed with short yen positions. And if we just look at the US-Japan rate differential on the 10-year, that probably suggests that dollar yen should be closer to 140, if not even lower. I don't think it's necessarily going to go there in a straight line in the next couple of days and weeks, no. But, really loading up on these short positions in dollar yen, again, that would require a much more dovish Bank of Japan, and it would require massive upside surprises on inflation. Whereas really what I'm after is, well, the 50 basis point rate cut in September, that's overblown, right? And sort of 4.5 rate cuts by January next year, that is too much. There is too little risk premium priced in on the long end now. Yeah, fine. But that doesn't mean that, the yen is going to go all the way to 160 again versus the dollar. So therefore, the carry trades near term, going to struggle probably.
Max Kettner, thank you so much. The Dow, negative 471. Max Kettner, I should say, with HSBC. NASDAQ, negative 1.7%. Intel, with an historic drop today on the edge of 26%. With our news in New York City, John Tucker.
All right, Damian and Tom, looking at some of the stories we're following. The 3 newly freed Americans back on U.S. soil at a landmark prisoner exchange with Russia. Journalist Evan Gerskovich, Marine veteran Paul Whelan, and Alsu Kurmasheva, a journalist with dual U.S.-Russian citizenship, arrived at Joint Base Andrews in Maryland shortly before midnight for a reunion with their families. President Biden, Vice President Kamala Harris were there to greet them.
Building the strength that we have through diplomacy to have outcomes like this. And there's so much at stake right now in our country and in this upcoming election, including who has which approach to understanding America's strength. This is an example of the strength of American leadership.
Meanwhile, the Kremlin said today that at least 3 Russians freed in the landmark prisoner exchange were undercover Russian agents, a rare public admission into the work of Moscow's top secret security services. Donald Trump dismissing pressure to debate Vice President Harris, saying he's leading in the polls and voters already know who they are and his Democratic rival, where they stand on the issues. However, a recent Bloomberg News Morning Consult survey found Harris erasing Trump's lead among voters in several battleground states. On Fox, Trump was also asked about enthusiasm in the Harris campaign.
There is more enthusiasm for how can you be enthusiastic about Joe Biden? Okay, I mean, how do you be? But I think she's actually worse. I think she's a horrible candidate because she wants open borders. She was a border czar. She tries to, deny that now, which is not working.
Meanwhile, Harris reporting a record $310 million fundraising haul for the month of July. Sports, Simone Biles winning her second all-around Olympic gymnastics title. And meanwhile, swimmer Katie Ledecky won her record 13th medal with a silver. As for the overall medal count at the Paris Games, the U.S. 39 medals, France is 28, China has 26. Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm John Tucker, and this is Bloomberg. Damian and Tom.
John Tucker, thanks so much. Inside Baseball with Damian Sassower.
Thank you.
A good EM country has debt issued in their own currency and debt issued in full faith and credit U.S. currency. What's the trend there right now? Are they issuing more in their own currency, or are they still wedded to the U.S. dollar?
Well, I thought you were going to ask me about the Yankees. They're winning 5 in a row, but no, I'll talk about the baseball of emerging markets. I think really at the end of the day, the capital markets are open to most investment grade EM sovereign issuers. And when I say the capital markets, I'm talking about the dollar bond market. So they're incentivized to go there. I mean, it's still open. There's still activity, but it's definitely not what it once was. And we have seen on the local side governments issuing in local currency like we've never seen before, and yet here we are. Yields are in the 6s and going higher. And so, I mean, again, where's the buying? Where's the foreign buying in that market? I just don't see it.
I mean, one of the big differences here is Jazz Chisholm has to look at the Miami Stadium, which is, worst in baseball. And all of a sudden, Jazz Chisholm's playing half his games in Yankee Stadium. I mean, there's no other sport where that's true.
No, I mean, well, look, they're tied for third in the major leagues. Did you see, by the way, that Mike Trout just tore his meniscus? He's out for the season. That's a terrible loss for Major League Baseball. But look, again, the Red Sox are 6.5 out of first. The Yankees are back tied with the Orioles, third best team in baseball. It's a good time to be alive.
It's a good
time to be
August.
alive.
That's good. We looked at the trade deadline. We're going to trade John Tucker for a player an announcer to be played later.
I'm the ultimate utility infielder.
You're very good.
Randy Velarde, exactly.
Of course, just what I was thinking.
Just down negative 500. It is Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. Recession fears front and center. After the lousy jobs report, bond yields, they are plunging. The 2-year yield down 19 basis points. We are at 3.96 right now, the more policy-sensitive 2-year yield. You heard right here on the program with Tom and Damian, Claudia Sahm of the Sahm Rule saying her rule has been triggered. It's a recession indicator. The major stock averages continuing their sell-off from yesterday, and the NASDAQ is headed for correction. Isn't helping that tech earnings disappointed. Intel looking at the worst decline in 50 years. Amazon also off to a rough start after the online retail giant reported revenue that came up short of expectations. And right now we have the S&P 500 77 points lower. That's a decline of 1.4%, 53.67 on the index. The Dow Jones Industrial Average down 500 points. The NASDAQ 100 right now down 381 points. That is a 2% decline. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Damian and Tom.
John Tucker, thanks so much. VIX out to 21.08, a little bit quiescent. We're going to get to a really important interview in a moment, but we have to Damian Sassower with our Olympics update. U.S. soccer team, Morocco always plays tough.
Yeah, they do. But we had a penalty kick go against us. Nathan Harriel of the U.S. men's team, he had a little bit of foul. They got the penalty kick. The U.S. men's team is now down 1-0 in the 42nd.
So that's what you've been doing all morning over there, is watching Olympic coverage?
Yeah. Of course, on YouTube. Of course. I mean, we've got YouTube here.
We got YouTube
Premium.
here. You set it up and you go.
And there we are.
Damian Sassower with our coverage. One thing we take great pride in is the eclecticism of going from academic economists to really, really bulletproof market economists, and particularly those that have embraced the digital age. No one is better at that than Julia Pollack, chief economist at ZipRecruiter, and oh my God, it's not Goldman Sachs or BNP Paribas or HSBC. trust me, folks, Julia Pollack's got a better handle on the American economy than some fancy pants in Midtown Manhattan. She's out in the trenches.
You are too kind.
Out in the trenches of California. Julia, I'm sorry, Ethan Harris was just on, a giant of economics, and he just said flat out, Tom, Damian, I've been wrong. Do you feel like you've been wrong here in the deterioration of the market, or is it the loss of confidence you've been writing about?
No, I feel like we've been right, and we've been warning the Fed. The Fed actually does tours all around the country, and they do talk to Main Street businesses. They talk to staffing firms and recruiting firms, and we've been all, telling them for over a year, things are worse than they look. The top line numbers don't make sense to us because what we're seeing is a big pullback in hiring, huge caution and nervousness about this economy, and a real effect of high interest rates on businesses' decisions to expand and hire. So we've definitely been warning of this. And the problem is, the labor market hasn't been sort of settling at normal. The Fed talked about a normalization in the labor market. Well, we didn't see any sign of things leveling off and normalizing. We saw a deterioration that has, in the last few months, actually accelerated. So we think they're behind the curve.
Well, Julia, Julie Su was on earlier, and she was talking about how we have to look at the 3-month rolling average, which is kind of a cop-out in my mind. But, I'd love you to explain for our audience the ZipRecruiter Job Seeker Confidence Survey report. What are you seeing there? It fell to, I believe, the lowest on record, no?
Yes. So we only started that survey in the beginning of 2022. So, yes, we did see that go to the lowest since then. But, other measures like our new hires survey show that the share of workers, of newly hired workers, getting raises, getting signing bonuses, getting benefits, those have all fallen. Sort of every qualitative measure we have of this labor market has been showing weakness, and many of them show that we've now gone to levels not seen since 2014, 2015. Outside of the pandemic recession. So we're not just back at 2019, we're in a worse place. The unemployment rate is worse, the underemployment rate is worse, et cetera.
Do you think it's a little bit convenient that in a week where the Fed basically started moving the market toward an easing cycle that we saw a number like this? Is this just coincidental?
I think it's just coincidental. I think the Bureau of Labor Statistics is really a bunch of bespectacled nerds who are very technocratic and insulated from the Fed and from politics. I think they really just take that survey and put the numbers in, as
See how harsh she is?
Really?
She's brutal. That's what, you go to Harvard and then you show up at Rand and they're like, we don't care that you went to Harvard.
She's an adjunct,
tough as nails.
Adjunct professor at Pepperdine. She's looking out over the Pacific Ocean. It's easy to make decisions about the economy when you're sitting there. But no, Julia, seriously,
when you're surfing.
You're right, exactly. So, seriously though, this economy, are we really seeing signs of deterioration? Do we see any hope if the Fed does indeed begin to start easing policy that things can turn?
I think there's a lot of reason to be optimistic. So in this jobs report, you see a large increase in the number of people on temporary layoff, 249,000. You see a significant decline in the work week to 34.2 hours. Those are the kinds of things that companies do when they're stressed,
right?
But they don't think that this is permanent, right? They think that if rates come down just a little bit, they can get these people back to work and they can give them the hours they want again. Most businesses see lots of opportunity to expand. Consumer spending has not tumbled. They really realize that this is all because rates are so restrictive.
Julia, one final question. I don't know if you've studied it yet professionally. Chevron walks away from California to Texas. Is this a trend?
Oh, it's a massive trend. You see it in tech jobs. The share of California, the California share of all tech jobs has fallen substantially. The California share of manufacturing jobs has just plummeted. California is losing lots and lots of companies to other parts of the country that have more business-friendly rules and lower costs of living. And it's just economics.
We're thrilled to have you close this hour out. Julia Pollack, thank you so much for ZipRecruiter today. And, a lot more coming up here with a down negative 405 as well. A minute and a half with one D Sassower who exits and, hits the turf here, the tee, I should say, is well. The linkage, I want you to explain to our American audience why Japan matters. Yeah. In all my years, this is one of the hardest things to get across. It's not this little island where they do shogun. It's like a ginormous, important thing. Discuss.
I get the same question about China, and I'll tell you in one word why they matter: reserves. These two countries hold to collectively $6 trillion of reserves, of dollars, basically. So, I mean, look, if they start selling dollars into the market or even buying dollars at the margin, that's going to move FX, and that's going to obviously filter it through into all of the levered trades that we've seen in this high beta regime, right? I mean, everything. So, yeah, it's all correlated. It's all connected. What's going to be interesting is the washout here. How deep can we go, Tom?
I mean, you're watching Morocco-U.S. You're writing your research note for Monday morning. Give us a tease here of what we're going to hear from you Monday morning.
All right, we've got some rate decisions next week. We start with Australia on Tuesday, India on Thursday, Mexico on Thursday, and Peru on Thursday. But it's Australia that's kind of interesting. They're going to be unchanged. But if the markets are rushing to price in lower rates across all of G10, I mean, who's to say that Australia might not be next in line, right? Yeah. And so, look, for the BOJ to hike in October, I think the market's a little bit ahead of itself. I mean, Japan tends to move very methodically, very slowly. And so, Tom, I don't really believe an October hike is in the cards, but I mean, they have surprised now. And look at where dollar yen is. I mean, 140. It's incredible in this move. It's mind-numbing.
Damian Sassower, thank you so much for joining us today. Really a crazy week. Thank you to our team. Richard Truman, Ken Folio, our global technical director, the whole team just killing it here.
Thanks, John.
With guests, and thank you particularly to guests that were squeezed short. John Tucker's here. Ari was here. He saved me like 6 times. I mean, I don't talk to him. He's a Yankees fan. I mean, that limits the conversation. Yeah, but it's really been an extraordinary week. We greatly appreciate your support on YouTube, on Apple CarPlay, and Android Auto. If you do one thing this weekend, if you haven't seen it, go back and look. I think now 10 years ago, I'm guessing, Tom Petty at Fenway Park. And the way it's filmed, it's like the cameras, they're not like at a distance. They're like right there.
Right there.
And Benmont's, it's just...
Kind of like me at the Fish Show last week.
Yeah, it's not Fish, it's Petty. But Tom Petty to get us out of this historic Friday.
They never would come to